standard deduction. Let's talk about standard deduction. The standard deduction is actually the base amount of the standard deduction. So what happens is there is an option. You can do standard deduction versus itemized deduction. And for the taxpayer, we want them to have the better of the two. So how do we define standard deductions? So standard deductions are preset amounts depending on what your filing status is. And actually, you can go in your 4012. Let's all turn to, somebody tell me where you're going to find standard deduction amounts in your 4012.
Tab F.
F is in Frank?
Yes.
Yep, everybody turn to F1. Are you there?
Yes.
Okay, so what's the standard, the base standard deduction for most people? If you're single, what's the amount? You see that up top, 12,000? Anybody not see that? Okay, what about head of household? 18, and then married filing jointly or qualifying widower? Yeah, 24,000, right? So those are the base amounts. Well, check this out. Here they are right here, by the way. Just so happens on your 1040. Look at them, same thing. So there's an aid for you. So you get that, based on your filing status, you get that subtraction, you get that deduction. It's called the deduction. Would go there, right? So the only thing that might change that base amount on standard deduction, there's two circumstances that could increase that standard deduction. And that would be the age of the taxpayer or whether they're blind or not. And if you turn the page to yeah, here, yeah, it's the next page, F2. And TaxSlayer is going to do all of this for you. I just want you to understand where these numbers are coming from. So if your client asks you, you can explain. Because if you'll see, if you'll look at that top chart on page F2, Frank 2, you'll see right up top, it says standard deduction for people born before January 2nd, 1954, or who are blind. So the converse of that date is that they're 65 or older, right? So how would TaxSlayer know what their age is?
We put it in.
Yeah, we put in the birthdays of everybody, right? So it's going to calculate that for us. And then through our interview intake sheet, we would have whether somebody is blind or not. If you look at the first page of your intake sheet, one of the questions they have to answer is whether, if you look in,
Legally blind.
yeah, legally blind, 6A, B, C, are you legally blind, full-time student, along with that area. So we'll know what the status is, and we'll be able to input that in their personal information. Okay, but notice. So let's just look at the single entry on F2. So it says if your filing status is single and the number in the above box is 1, then your standard deduction goes from 12,000 up to 13,600. Right? You see that in your book? If you're single and the number in the above box is 2, then it's 15,200. So what is that saying? What that's saying is if you're single and you're blind, then your standard deduction is going to go up to 13,600. If you're single and you're both blind and 65 or older, then your standard deduction is going to go up to 15,200. Okay, that's all it's saying. All right. So potentially, what's the max standard deduction for married filing jointly? Anybody?
29,200 if you're both over 65 and blind.
Yeah, 29,200. You see it on the chart? So it could go from 24,000 up to 29,200 if both taxpayer and spouse were 65 and older and blind. Yes, ma'am.
Why did they choose blind only as a disability? Why didn't they choose all disabilities?
I don't know. You know, as I say, I didn't write it. I just read it. But yeah, to be honest with you, I don't know the history. It's a good question. I don't know why they didn't give it to deaf or, you know, a myriad of other disabilities. Yeah. Yes, ma'am.
So
So what are the numbers telling me? When you're single, it's just one person filing, but now you're telling me two. What does it mean?
No, those numbers are
Okay,
relate to if you're blind or the age of 65 or older. Yeah. Okay. So head of household. What's the base amount for head of household standard deduction? Okay. And how much could it possibly be? Yeah, 21,200. Okay. So, by the way, these have doubled from this is the tax legislation. The current tax legislation actually almost doubled, if not more than doubled, these standard deductions. And I'm not going to. So what they did is they gave that, but they also took away something else. But nevertheless, this is where we are in standard deductions. Okay, so everybody's clear on how the standard deduction is. It's a defined amount. It's based on our input. It's determined for us, right? So all we need to figure out is, can we beat that? Can we beat that by using itemized deduction? And to be honest with you, for our client base, 99% of the time, it's standard deduction that's going to win the day.
It's at 24 at this point.
What's that?
Because the deductions are so high, the standard deduction.
Yeah, because they up to a standard deduction. And in itemized deduction, what the items that are actually you take into consideration to see if you can beat the standard deduction are interest on a mortgage, real estate taxes, charitable contributions, and medical, but in excess of greater than 10% of your AGI. So it's not like every dollar of your medical even goes towards it. It's you start at 10% over your AGI. And I list these, there's others, but these are the primaries. And if somebody doesn't, number one, if somebody's renting and they don't own a home and paying on it, there's no way that's going to happen. And nowadays, with interest rates so low, you know, typically people that I'm dealing with have a house payment of, I don't know, $800 to $1,200 because I'm asking them and talking to them. You know, so maybe 75% of that goes to interest, right? So there's $700 times 12, that's $8,400. You put in taxes, you know, maybe you're at $10,500, and they give me the numbers. But it's, and then married filing jointly, they got to clear $24,000, and it just doesn't happen very often.
Because it would be more than half their income if we're doing people under 55,000, right?
Well, that doesn't have, it's not that, it's just factually. The numbers just don't beat the standard deduction. See what I'm saying? I mean, if I took these and put values to these.
What's the acronym on the second one?
Real estate taxes. When you own a home, you pay taxes. And if you have a mortgage, you're paying interest and principal, and you're able to itemize the interest portion of that.
So question, let's say they're teetering right on the edge of one of those and they're not really sure which they should do.
They're teetering, you're saying teetering between
standard with what they have. Does
yeah,
the system decide, or do we have to?
No, you decide. Then you decide, okay, I'm going to go down that path, and let's go check it out. Because there are some other, there's sales and local taxes, and it's calculated by, that's your sales tax, and that is calculated by tax layer. And nobody knows that until it goes through the calculation. So if you're on the edge, go ahead and do it, and let's see it.
So if they bring in all those documents that everybody gets from their mortgage lender, if we have to decide whether we actually use those or not.
That's right.
Okay.
And all I'm telling you is that it's very rare that you will, but yes, definitely look at them. And they'll bring in their annual mortgage statement, and it would have interest and real estate taxes on it. You may have to look around because they're all different depending on the lender that gave you that. But yeah, you definitely look at it. But 9 times out of 10, what ends up happening is they want to know why they can't use it, and you have to explain it to them. And that's why you need to know, what's going on behind the scenes. But that's it. That's the discussion. It's one versus the other, and standard typically wins the day with us. And even on the itemized deductions, now the new tax legislation, by the way, limits the interest. Doesn't it cut back to like 10,000?
Yes,
Taxes, excuse me, taxes. Yeah. So, and not to get too far out there, but it may be that your client can do the following in order to every other year itemize. Because you can pay 2 years worth of taxes in 1 year. You can play the system. And if that helps them to be able to take advantage of itemized 1 year, then, you know, every other year, then maybe they want to do that. But you have to sit and look at the numbers. Yes?
For a self-employee, they have to itemize, right? They can't take
No, that's a whole different conversation. That you're talking about, they have to itemize their expenses.
yeah, for self-employees.
Right. Well, right, and that goes on Schedule C. This is a whole different world. This is a whole different part of the tax portion. Okay. This is just talking about this line: standard deduction or itemized deduction.
They can essentially take a standard deduction personally, but then itemize when it comes to their Schedule C.
Yeah, and I don't even like to call it itemized because it is confusing. They detail their expenses on their Schedule C, okay? But this, so these expenses, I would dare to say, typically aren't going to show up on a Schedule C. It's a whole different pot of different expenses that are related. If you're doing some, you know, home office expense or something like that, perhaps you can include some of these in your Schedule C. But typically, this is a whole different category. Okay? You follow? It's a little confusing, I know. Yeah. Yes?
What is the medical part? What did you say about medical?
Oh, all I'm saying is that before you can start, the portion of medical that you include in this, it's those dollars that exceed 10% of your AGI. So if you had AGI of $30,000, right, times 10%, then that would be $3,000, right? You can only include qualified medical expenses that exceed the $3,000. You couldn't include that first $3,000, whatever that figure is. That's the distinction I'm making. So it's a larger threshold for that, because people will show up and go, "I spent $400 on medical. Can I include that?" You're like, "Well, let's look at your AGI. Their AGI is, like I say, 30,000, and they had, so 10% is 3,000, so you couldn't include that 450 in the itemization calculation because they're below. You can't even start including medical until you exceeded 3,000. Okay? Okay. So that is, any other questions on standard versus itemized?
I'm still confused with the Schedule C and this.
Okay.
So if we're doing the Schedule C before we even get to this section, and we're itemizing for a Schedule C, do we even do this then? I guess, like,
Well, it's different sets of expenses, because on a Schedule C, what's your business? What do we say? Cleaning. Yeah, you're cleaning, right? So you have your revenues, and if you're a housekeeper, maybe you had just a cash ledger showing, payments from the contractor. And then your expenses, in that case, for cleaning, is cleaning revenues. Okay. So maybe you had to buy equipment, vacuum cleaners, right? What was necessary and ordinary expense to do that cleaning business? Vacuum cleaner, we'll say, for instance. And you had to have supplies, your different cleaning products, etc., right? And hang on, and maybe you had mileage, maybe you had some business mileage for that. See, it has nothing to do with those. This is specific to the business.
So this would be line 9 then, for the qualified business income deduction.
Well, we haven't talked about that.
Well, I'm saying this compared to this. So this would come first, either way.
Yeah, these relate to our question of itemized versus standard, whether we're going to do standard or itemized.
It's almost like it's two different buckets.
okay.
Yeah.
So like that's going to
Yeah.
be like at the top portion of when you're doing the form, when you start looking at the form, and then the Schedule C is coming in a whole other section.
Right.
Because
Yeah,
like that,
I think
all
that's
that
what
is
confusion
where your
is.
AGI comes from.
Well, it's after, it comes,
I mean, after
yeah.
So we're just trying to create, so when we're doing Schedule C, we're just trying to figure out the AGI, and then we're gonna funnel into this to see which side.
Well, when we're doing the Schedule C, we're just trying to figure out whether there's a profit
I don't
or
know about
loss.
that, I'll figure it out.
Okay, no, but it's a good question, because obviously I'm not communicating this well, and it is confusing. The Schedule C is a type, represents sole proprietor income, or self-employed, right? And it just so happens that it's the one that the story is larger than just the W-2. Because typically on income, we just see income coming in. But in order to get to Schedule C, sole proprietor income, we take revenues minus the expenses that are ordinary and necessary for you to do that work, whatever it is. Okay? And so that comes to a net profit, Schedule C net profit, and that is what flows through what we said over here on your Schedule 1, line 12.
Okay, so Schedule C would be before.
Yeah, Schedule C is before.
Okay, so yeah, I think that's what.
Yeah, maybe that's where it was confusing. Yeah, Schedule C took place before standard deduction versus itemized.
Okay.
Does that make sense?
Yeah.
Okay. Yeah, no, thank you for asking, because we want to make sure you get that. So yeah, all that happened in Chapter 1. And now we're down here, further into the story, trying to figure out, because we identified Schedule C, and Schedule C, if it was there, flew through here, flowed through there, came through there, whatever the word is, and you had your total income, yeah. So now we're trying to lower the AGI, and we just talked about standard deduction versus itemized. Now it's clear? Okay, good. Thank you for asking. And ask again and again until we get it. Okay, so now, let's see if there's anything else I wanted to say about. What's that? Okay. Okay, so that takes care of that. Yeah. Okay, so now let's go to the next line. Oh, yes, what?
So we said over here, medical expenses 10% of AGI, but in the book it's saying 7.5.
They changed it. I thought it went up to 10%.
Line 3, where the medical and dental expenses more than 7.5% on your adjusted gross income.
Yeah, and for some reason maybe it's the age. Okay, 7.5. I thought it had already bumped up to 10.
Leave it as tax layer will calculate.
Yeah, no, that's right. But yeah, thank you.
That's right, all in there.
7 point. It's greater than 7.5. But again, tax layer's gonna,
It'll know it.
you'll know that. Yeah, you'll know the AGI. But I'm thinking it's going up to 10% here pretty quick. It may phase out because it used to be 7.5, and part of the new tax legislation increased that to make it more difficult to qualify for those.
But is that going to happen for people doing taxes for 2018, or is it
It'd be beyond.
Okay.
Yeah. Be beyond. I'll look that up on break and clarify that.
Yes, it's after tax year 2018 reverts to 10%.
There you go. It's after 2018 that it reverts to. Thank you. Yeah, to 10%. Because I knew it had been 10 and it dropped, but I thought that it was already phased out. So. Okay, thanks for, again, clarifying that. Okay, so now we're at a potential, another potential deduction, and this is new. It's called qualified business income deduction. This is the first time we see this, as long as I've been doing tax returns. And that is tied back to Schedule C, to the net profit. So we're touching Schedule C several times. And what it is, and TaxSlayer does this for you, but it's the lesser of 20% of the Schedule C net profit or 20% of your taxable income.
And that's line 9?
Yeah. Which is interesting that it can jump ahead and figure it out, but it does. Yeah. So, see, so what the genesis of this is, by the way, corporate America got all their tax rates reduced quite a bit. The tax rates for corporations, which we're not dealing with, but I don't remember how. Would you know what the drop was on the corporate tax rate? How high it used to be?
It used to be as high as 39. It's now 21.
There you go. It's huge, right? And the whole idea is spur investment and get corporate America to bring their cash back from all those foreign entities they've had. And of course, they all turned around and gave everybody a small raise and handed out more dividends. And if you own stock, goody for you. Anyway, that's permanent. Those are permanent tax cut rates. So Congress was able to negotiate a break for the non-corporate business owners, the small guys, the sole proprietors, our Schedule C people and Schedule Sub S and some of the other small business entities that small businesses will use. But as it relates to us, so what Congress said is for 5 years, we will do this, we will introduce this qualified business income deduction. And it's a calculated amount. I just need you to know what it is so that if there's a value that shows up there, that you can explain what that's tied to. And again, it's tied to net profit that's coming off of the Schedule C. And it's the lesser of 20% of that Schedule C net profit or 20% of taxable income. You're actually going to see this because when you do Drake, and we'll work on Drake today. Hopefully, most of y'all will have a chance to get into that exercise. He's the Uber driver, ride sharing, and this would impact. He would get the benefit of this. I was thrilled to see it. I got it this year too, and I was like, yay, because you can actually make more money, right? 20% more and pay a little less tax. So it was a nice break. But by the way, the self-employment tax, because remember we also said this net profit is part of how the self-employment tax is calculated, and we'll review that again here in a little bit. You don't get that discount before the self-employment tax is calculated. You pay the self-employment tax on 100% of your net profit. It's only the calculation of the federal income tax where you get that discount against your Schedule C net profit. Okay? Yes, ma'am.
How exactly is that calculated if it's just a comparison of 20% of profit per your?
Well, so what are you saying? So if you have 10,000 here, then the lesser of this would be 8,000. Let's see, no, 20% would be 2,000, right? And then tax, I can't do it because I don't know what the numbers are, but then tax layer would come up with whatever 20% of taxable income is, and then it takes the smaller of the two.
And you input that into Schedule C?
No, tax layer inputs it for you here if it applies.
Okay.
On 9. It takes the information from Schedule C for part of the calculation because it's based on, at least the first part of it is based on Schedule C net profit. It's the lesser of 20% of Schedule C net profit or taxable income. But tax layer does all that for you. It just needs you to know why is there a number there? What does that mean? Okay? So it's just a deduction that would apply to people that a taxpayer who has, did a Schedule C because they work for themselves. Right? And you may have one taxpayer works for themselves and one that has W-2 wages, right? And that's cool. They still could get this because the one that did the Schedule C is going to be driving whether or not make them eligible for that. Okay?
This lower the income tax, right? Taxable income.
Taxable income. That's right. Because check it out. We were at AGI, and if the standard deduction will decrease the AGI and lower the taxable income. If they get a qualified business income deduction, that would lower the figure because those are subtractions. And then you get to taxable income. So it's 7 minus 8 minus 9 gives you 10. Deductions take away, right? We all know what a deduction is. So it can lower the taxable income. I know they use all these different names, but AGI is here, then the system will subtract the standard deduction or itemized deduction, the greater of the two, and then it will subtract, if applicable, a qualified business income deduction.
AGI is line 7, I'm sorry, right?
Uh-huh. Yes, correct. AGI is line 7. And then by math, again, the system subtracts 8 and 9 from line 7, and now we are at taxable income. Okay, everybody? Questions? Okay. And now, for the first time, we see what potentially could be the tax that that our client is going to owe. Okay, but now we got to talk about credits and other offsets that could further reduce the actual tax. The tax itself is going to be calculated by tax layer, and the number is just going to pop up here. There are tax tables. If you wanted to go look at, you could look at them and determine the tax yourself, you know, old school. But all that's been loaded into the software, and it does it for us. But that tax amount that'll show up here, and then ultimately come over here, adding any amount from Schedule 2 will be calculated for us. So what is Schedule 2? Let's see. Yeah, so Schedule 2 includes what's called an excess premium tax credit repayment, and that's related to health care coverage, and I will cover that later. But yeah, that's where we are, okay? Any questions? So we will now get into our whole discussion of credits. Unless anybody, does anybody need a break? Are you okay? All right. So now we're going to launch into potential dollar for dollar offsets to the tax. We're no longer talking about taxable income or AGI or that. We're now beyond that because we just calculated, tax layer just told us what the actual tax is that's potentially due. And now, based on this whole discussion of what credits might apply to our taxpayer, we're going to see if we can't reduce that tax liability, and not only reduce it to zero, but possibly through refundable credits, get them some money beyond that they walk away with. I'm looking for a chart that I have. Let's see, here it is. Yeah. So these are all the non-refundables that we're going to cover. Child and dependent care, and these are all in your book. Education credits. And there's the American Opportunity. And your lifetime learning. And your retirement contribution. Retirement savings contribution. And your child tax credit. And your credit for other dependents. And then there's even a residential energy potential. And then over here, you've got your additional child tax credit. max of $1,400 per child. And you've got earned income. This is the big one. And you've got the refundable portion of the American Opportunity Credit. And then the net premium tax credit, which is related to, as well, health care. So, first question. What's the difference between non-refundable and refundable? Anybody?
Non-refundable, you're gonna get back in money form.
I'm hearing non-refundable, you're going to get money back.
Refundable.
Refundable, you're going to
It's
get
like
money.
credits.
What's that?
Non-refundable is like credits. Lower your taxable income.
Your taxable liability, not your taxable income, but the tax liability. Because remember, the taxable income is here. Now we're below that. We calculated what the taxpayer calculated what the tax is, the tax liability, and now we're trying to lower that dollar for dollar, right? So yes, the non-refundable can lower your tax liability to 0. But if you have non-refundable credits in excess of that tax liability, you lose them. You walk away because it can only serve to lower your tax liability to 0. Beyond that, sorry, can't carry them forward. Can't use them next year. There's, no. That's life. Whereas the refundable, if you get through all your non-refundables and you still have tax liability, then the refundables can take care of that tax liability and go beyond, because they can end up with money in your pocket. They can actually put money in your pocket to walk away with. Okay? So, which is more valuable? The refundable, right? The refundable. Yeah.
It's child and
Dependent care. Oh, I'm sorry. Yeah. Independent care. Yeah. Yeah. So we'll put them in this order because that's how they're going to flow. And so you'll see here, we start calling them out. Child tax credit, credit for other dependents. So let's move into these. So there's actually the Schedule 3, I believe it is. Let's see. Yeah, look there. Non-refundable credits. So this is the order I'm going to discuss these in. Education credit, yeah, pretty much got it. Yeah, there you go. Cool. Okay. So let's get into our non-refundable credits. And in your 4012, where would you find those? Which tab? G, right? Okay, so I'm going to start with the credit. I'm on G5. The credit for a child and dependent care credit expenses. Who's a qualifying person in that scenario? And again, I'm on G5. A qualifying child who is under the age of 13. And it's a different age requirement. You'll notice from dependency and other things. All these things are some of these things are triggered to age. But this one is a qualifying child who is under the age of 13 when the expenses were incurred, and who can be claimed as a dependent. So the unique thing about this one is that if the child was 12 or under for 6 months, let's say, you can actually take 50% of the eligible expenses. Whereas typically it's what the age is at the end of the year, right? Which dictates whether or not you get any qualified expenses. In this scenario, you can actually prorate it depending on how many months of a year. If the child turned 13 in any given year, you can actually still take a percentage of those expenses depending on when they turn.
What's the difference between this and 35% of 25% of 1,000? It's gonna be 10,550. What's that? I read yesterday it was 35% of 2,000.
35% on 2,000. I'm not sure. what you're referring
Right.
to.
These credits, yeah.
Uh,
It's gonna be $10, $50.
For child?
Child credits, yeah.
well,
Yesterday, I'm sorry.
yeah, you heard it from me?
No.
Oh.
From IRS, I saw it.
Well, the child tax credits,
Oh, it's for, I know, for earned income or.
Oh, it's
or
earned
unearned-
income?
Unearned income, if we want to, who we can,
Who
must buy. They have
4150,
here-
4150, that's
They
right.
have here, for the person who is under 65 or something like that, for your unearned income.
Oh, unearned income, you
No,
can't
it
see.
was a chart. I was reading about that.
Okay. If you find it, show it to me, because I'm not sure what you're referring to. Anyway, so the child and dependent care, non-refundable credits. So we said, who is a qualifying person? A qualifying child under the age of 13, or any person who is incapable of self-care, whom the taxpayer can claim as a dependent, and couldn't have been claimed as a dependent except that that person had gross income of more than $4,150. And then third, a spouse who is physically or mentally incapable of self-care. And it gives us the definition of that. The qualifying person must live with the taxpayer more than half the year. And they have to do that to be a dependent anyway, so that's no different. Okay? Again, I'm just looking at, everybody be looking at G5. G5 is where all this information is, okay?
Can I ask something?
So, yes?
You're married, filing joint. How can your husband be dependent?
He can.
He can't, huh? Okay.
Even if he's mentally incapable of self-care?
He would still be your spouse. Yeah.
Well, maybe she is head of household, we can put him as a dependent.
Not their marriage. They're married, yeah. They're married. Yeah.
We'll check it out, IRS.
Yeah, it says a spouse. It
Yeah.
says a spouse.
What's that?
It says a spouse who is physically or mentally incapable of self-care. So even if they're filing jointly,
They
it's,
still, yeah, they can still take the dependent
okay.
care credit.
Oh,
Yeah.
okay.
Yeah. Oh, that was your question. Yeah. Yeah, you can still qualify. Yeah. So, we typically see this for children under the age of 13. That's where we really see most of this, because we've got single moms, particularly single moms that are working, right? And they have, they incur the expense of child care. So, but check it out, because the qualified work-related expenses are specific, and it says qualified work-related expenses include expenses must be paid for the care of the qualifying person, right, to allow the taxpayer and spouse is married to work or look for work. The care includes the cost of services for the qualifying person's well-being protection. Expenses to attend kindergarten or a higher grade are not an expense for care. But after-school care does qualify. It's just the tuition for kindergarten or higher grades does not qualify for this credit. But after-school care does, okay?
Tuition at a public school, at a private school?
Yeah, no, you can't take any of that.
I mean, but you don't pay tuition for a public school.
Right, but they're referring to, you know, a private school, a charter school, or you're paying that. But that's the distinction to make. Furthermore, welcome. I think you can, yeah. Oh, what I was going to say is that pre-K does qualify. Pre-K does, yeah. So kindergarten, higher grades do not, but pre-K, if you pay for pre-K, that is a qualified expense for purposes of this, and we'll see that, okay? And then I think it says summer camp is as well. Summer day camp is qualifying, but if overnight stay is involved, then that's not qualifying. Okay, I'm not sure why the distinction, but that's what the tax law says, okay? So the trick is that when we get this information, if you look on, let's see, there's a page that says that.
So like for example, let's say numbers. I pay $200 a month for after school care. I can take those $200 and say I'm paying $200 for after school care for my child, and that 200 will be my non-refundable credit?
No. Number one, the 200 becomes 2,400 if you're paying it every. I don't know how many months you paid is the question.
Okay.
Yeah.
Yes.
And then it's a percentage of that. The taxpayer will calculate that.
Okay.
That may or may not help you. Because if you have zero liability at that point, then it doesn't help you because it's not refundable. But it could. But it's a percentage of
Well,
it.
it's like a percentage of
It's a
that.
percentage of the
So
qualified expenses.
You can add, for example, childcare, summer camp, whatever, and
That's it. If
you
they're
get
qualified
a-
expenses, get 10,000 or
10,000,
whatever. And
you
then
get a
it's-
percentage of that.
yeah, it's going to limit it. Because I think the max eligible expenses is 4,000, as I recall. 3,000. 3,000. Yeah, 3,000 and 6,000 total. So you could have two. Yeah, so it would knock down your 10 to 6 if you had 2 or 3 if you had 1, and then take a percentage of that. But we'll put in whatever you got, and then tax layer will take that. Yeah. So anyway, what I was going to say is that when you're doing child care expenses, often, besides understanding that it's a qualified expense, often the discussion centers around the fact that what we need to evidence the expense, especially for after-school care, pre-K, whatever, we need to have a statement from the provider, and it needs to have their tax ID number. So if it's an individual, their social, whatever, or if it's a company, their tax, EIN number, as well as make sure it's the current year, make sure it says for who the services were rendered. For the kid, we need to see the kid's name and the amount, right? And so what often will happen is they'll come in and say, my sister takes care of my kid and I pay her $200 a month, let's say. Can I include that? And we'll say, well, do you have a statement? No, but I've got proof and I have the backup. So, well, the thing is, if we're going to list it as a qualified expense, what I have to have your sister's name, I have to have her address, I have to have her social security number. Because if you report it as a qualified expense, then the IRS is going to be looking for it as what on her return?
Taxable income.
Income. And that's where the conversation. Well, a I-10 or whatever it is. Yeah. But often the conversation ends there because the sisters don't want to report it and they're like, okay, never mind. Okay.
The disabled
And how
grandma
much
and
is
all
that?
that.
The child care credit, how much is that?
What?
The amount. The child care credit.
No, the credit itself is a calculated amount. That's what we were just saying.
Oh.
Yeah, tax layer will. Yeah, it depends. There's a lot of factors that go into it.
There's a threshold for that. It's 400,000, right? For AGI. I'm asking for the AGI.
Oh, what's the limit, like,
Yeah.
you make over a certain amount?
Yeah,
you get that.
it does phase out over time, and I don't know.
I think it's 120 this year.
Yeah.
I think that it dropped.
Yeah, but
Yeah.
it doesn't impact our clientele, because remember, we're doing less than 58,000.
They're asking.
Yeah, well, yeah. So you can look it up. Go to the IRS. Yes, you can definitely look it up and see how it phases out, because it does phase out based on AGI. You're correct. I'm just telling you that we don't see that with our client. They, to the extent they can take advantage of it and they have, truly qualified expenses, then they shouldn't be phased out because of their income. Any questions? Okay. So that is a popular one. You'll see on G7 what the input itself looks like. And basically it's 3 steps. Step 1, you have to identify the total expenses and the total amount provided to borrowers. And then step 2, we actually enter the total amount of qualified expenses paid for each dependent. And as it tells us there, you can't exceed $3,000 per kid and $6,000 limit for a family for tax holders. But again, you put in whatever numbers you are right. The limitations are written into the software. So that's really all I was going to say about the child care and dependent credit, unless somebody has any questions. Yeah, the credit ranges, to answer your question, 20 to 35% of the qualifying expenses. It's based on the taxpayer's earned income and adjusted gross income. 20 to 35%. Yeah, and again, how would we know if there are child care expenses? Where would you know, where would you have picked up on that? Intake sheet? Where? What line? What row? What page?
Part 4.
Part 4, I'm hearing?
Line 5.
Yeah, part 4, line 5. Y'all see that? Bless you. Yep, okay. Yeah, and sometimes the employer will actually cover child care expenses, and that would show up on the W-2. Clearly, if the employer is paying for it, then the taxpayer doesn't get credit for that. It's not coming out of their pocket, right? That's the employer taking care of that, not them. But we would have seen that on the W-2 as a contribution.
So kind of a way to kind of cheat on this one is like if you see a yes, you need to check on that. If you see no, you're good.
Keep going.
If you see unsure, then you have to question.
Deal with it. That's right. Absolutely.
Yes.
Yeah.
That's one you have to check.
Absolutely. And clearly, if you have last year's tax return, you're going to look at that because maybe they missed something, and you want to make sure something didn't fall out. Even though they said no, maybe it does apply. But you've had last year's tax return for that exception. Yes, ma'am.
So would there be like a separate form or anything if your job offers child care reimbursement?
It would show up on the W-2, and there'd be a code for that would come
That they
through.
reimbursed you however much? Okay.
Mm-hmm. Yeah.
I'm still looking at the credit per child. On the bottom of G8, it says both spouses must have earned income in order to claim the credit. So if you only have one spouse that's working to support the family, they won't get the credit?
Let's see what that says. Both spouses must have it. Complete.
The other has to be a student. The other has to be a student.
Wow.
Hard time. You can't pay if you just have one.
If it one bread. Yeah, because then I'm sure the IRS says, well, they can stay home and take care of the kid.
Care, okay.
Yeah.
Like one of the spouses is home, okay.
Yeah. And that raises a good question. Remember, this is the child and dependent care credit, not to be confused with the child tax credit that we're going to be talking about later. It's a separate one, child and dependent care. Yes, ma'am.
Does this software then, maybe close your ears, I'm just asking. When you see that child and dependent care on a W-2 and you input it into the system, does your software just ignore that, or must you then go over and document it over in the child care section?
I'm trying to remember how that.
Because the software I use, if I don't put it over there, it taxes them for the $5,000. But this may be designed to where it ignores it. That I don't know.
I think it ignores it, as I recall.
That's why I said cover your ears.
Yeah. I think it does. I think that's true. Okay, so that's our first non-refundable. Let's keep moving, and we're going to talk about education credits. This is a frequently used credit that our clients are able to take advantage of. It's got some nuances.
What page is it on?
So you tell me, what tab would you go to see education benefits?
Oh, so we're done with that?
J.
Yeah, J, right? So yeah, now we're into J. And I'm going to start with a comparison of the two education credits that our taxpayers would potentially benefit from. So go to, if you would, J4. Okay? Now, in TaxSlayer, you drive which credit, if it applies, which one of these two credits they're going to give them. It's either American Opportunity or it's Lifetime Learning. And check it out. Remember I said, under non-refundable, I've got American Opportunity and Lifetime Learning, but I also have American Opportunity under refundable. Because in fact, 40% of the qualified credit can be refundable. So, which would be the better credit for your client? Which would be more advantageous, would you think? Yeah, the American Opportunity, right? Because potentially there could be some money in the pocket. So if at all possible, you want to put the qualifying expenses, and we're going to go through the definition of that, you want to treat it as American Opportunity credit, right? Versus the Lifetime Learning. So what's the difference? So as we look on J4, it says, comparison of education credits. The maximum credit for the AOC is $2,500. By the way, Lifetime Learning is $2,000. So there's another reason why you like to get them into American Opportunity. The credit's more, right? $2,500 versus $2,000. There's your limits on modified income where it phases out. $180,000 and $90,000 on the American Opportunity credit. Let's stick with American Opportunity credit. Refundable or non-refundable? 40% of credit may be refundable. The rest is non-refundable. Per the footnote, the only exception is an age thing. So if the taxpayer is between 18 and 24 or under 18, then there's limitations on whether or not they get the refundable. There's just an exception that clause out. The software will help you determine whether that's the case. So the American Opportunity covers, it's available only if the student has not completed the first 4 years of post-secondary education. So basically we're talking about the undergraduate degree. You can do associates for a couple of years, you know, and then flip into an undergraduate degree. But 4 years max that you can take the American Opportunity credit. And it has to be for expenses incurred to go for a degree as an undergraduate, basically, what we're talking about. Yes, ma'am? Can
you claim more than one? Because like me being a full-time student and my son being a full-time college student?
Absolutely. If you're working, and depending on what degrees y'all are working on, etc., it could be both be American Opportunity credit. Okay, yeah, and then number of tax years credit available. Again, available only 4 years per eligible student. So how am I going to know if how many years they've used it? How are you going to know that? Well, yeah, not even the intake sheet. What it comes down to is the interview and talking to them. Yeah, and I mean, number one, my first question is, what year is this person on their degree, you know? Oh, they're a sophomore. Okay, well then it stands to reason. Did you probably took it, maybe you took it last year at best, so this would be the second year, right? And so we'll ferret through that and talk to them.
Previous filing?
Yeah, previous filing, absolutely. Yeah, that prior year tax return, you'd look at that and see if they took that last year.
What if the person just went to some taxpayer and then didn't even know what they were, I mean, maybe the person just filed it for them, did not explain that, and they are not aware of it.
Well then, if they're eligible for that in the prior year, we can do an amendment for them. Yeah, we can help them correct that.
Oh.
So if they didn't claim the American Opportunity credit in a prior year, let's say it's the sophomore again, and you ask them, they said, no, we didn't even know about that last year. He was a freshman, and yes, we had expenses and all that. You say, well, let's then talk to your site manager, and then we can do an amended return for them, and then they get some more money back. Yeah, so that's the other reason you ask the questions. Okay, let's see, where was I? Number of courses. Oh, type of program required. Student must be pursuing a program leading to a degree or other recognized education credential. Number of courses. Student must be enrolled at least half-time for at least one academic period during 2018. Enrolled at least half-time for at least one academic period. Okay, what was it, 3 months? And I will show you the one of the forms we get from the colleges, the 1098T, which goes hand in hand with the information that we need to do this credit. will tell us whether they were enrolled half-time or not.
And
Yes?
it's 4 years regardless of whether they went part-time or full-time?
It is 4 years, correct, the first 4 years. But, oh, so what do you ask me? They could skip around? Maybe it's a 6-year duration in college and they were part-time a couple years? Yeah, I'd save it. Then I would save it. Yeah. Number of course, no, we talked about that. Felony drug conviction, student had not been convicted of a felony. Again, they'll have to tell us that. Qualified expenses, and we'll get into this a little more too, but they include tuition, required enrollment fees, and course materials that the student needs for a course of study, whether or not the materials are bought at the educational institution as a condition of enrollment or attendance. So, in other words, you know, people rent their books, people buy them from Amazon or whoever. So we can include those expenses for books, course materials, even a laptop if they're doing it online and they have to have a laptop in order to take the class. We prefer to see the receipts. So, because again, it's their tax return, but I want to make sure they have the documentation ultimately, so if they were audited, they're good to go, right? I do them a disservice if I don't do that. But there have been times when I'll say to somebody, well, was there any expense for books? And they go, yeah, well, how much? I don't have the receipts, but you know, I'm thinking it's like $300. Are you sure? And I'll go with that. I'm comfortable. I'll just say, but make sure when you get home, put your receipts in your folder and have them for backup in case you need that. Yes?
What is the for FAFSA? Like for that for FAFSA?
Yeah, so that's depends then. Do they get a grant or do they get a loan?
And what if they get a grant?
Yeah, so a grant.
Did they still apply for this?
We'll show how that impacts the amount of the qualified expenses. We're going to net the total expenses against any grants. And then 10 needed, the TIN, that's the taxpayer identification number. Filers and students must have a, so see what that's referring to? It used to be that you could do, if the reason you didn't take the American Opportunity Credit is because you didn't have a social or an I-10, but now you got it. You used to be able to go back 3 years and amend and take advantage of the of the American Opportunity Credit. But they've taken that away. You have to, our client or their son or daughter have to have their Social Security card, or their ID, Social Security card, by the time of the due date of the tax return. So you can't go back anymore. You can do a tax return because you just forgot, you didn't know to do it, but you had to have had the Social Security card.
Only Social Security.
It's either social and I-10. EIN. No, that's that. Yeah, it can be. I'm thinking it can be I-10 as well. TIN is a taxpayer identification number. That's just more general.
A lot of students do get Pell Grants, and that reduces the amount.
Yeah, and I'll talk about how the grants impact their qualified expenses. Yes? Okay. And then you must provide the educational institution employer EIN on your form. Yeah, and we'll see where that is. Lifetime learning credit, meanwhile, you'll see it's up to 2,000 credit per return. There's your limit on the Magi. Again, our folks aren't encumbered by that. It is totally non-refundable, so credit is limited to the amount of tax you must pay your taxable income, right? We know that. Available for all years of post-secondary education and for courses to acquire and improve your job skills. So this is where my graduate students fall into. Anybody who's in graduate school, and often, you know, some of our taxpayers are going to night school, taking graduate courses, or for their work, they're taking classes, self-help classes, computer skills, reading skills, writing, whatever, marketing, whatever it might be. And those we can run through our lifetime learning, okay? But note, those course materials, it's only those course materials that you buy from the institution that is where you're taking the classes. So like grad students, probably they're buying books and things from Amazon and all that, but you can't include those as qualified expenses for this credit unless they actually bought them from the school where they're going, where they're taking the classes. So there's a fine distinction there, but it is a difference between the two. Okay?
What if it's just like an online learning course, like let's say a Six Sigma class, but it's not necessarily an institution?
Yeah, no, well, let's see what it says. I think you're going to be fine. Yeah, because it's not like they didn't require EIN or anything for the educational institution, so it's a self-help class.
Okay.
Yeah. Number of tax years credit available for an unlimited number of tax years. Type of program required. Student does not need to be pursuing a program leading to a degree or other recognized education credential. So we'll have people that are pursuing licenses, beautician license, things of that nature. We can run through lifetime learning.
What about like prep classes, like MCAT prep classes?
I would say lifetime learning, if anything. Okay. Yeah, because that's not for the degree per se. That's just getting ready. Okay, we talked about that. Payments made in 2018 for academic periods, et cetera, et cetera. Okay. If you'll turn just for a second to J6. That is what the 1098T looks like. There's a blank form there, you see that? I can get one up on the screen too. Let's see if I can, if that helps. And the reason I want to review that is, let's see, about, where's the form? Oh, come on. Here we go. Yeah. Yeah, there it is in red. So remember we were talking about, this is a source document. They have to have this form. If we're going to do American Opportunity Credit, they have to have this form. And oftentimes, unfortunately, it's coming through the son or daughter, and mom and dad, one, don't know about it. Secondly, they don't have it. And so often we will prepare their return, put it on hold so that they can go find this form. Though I've had my clients call their son or daughter and they can immediately get them to it, take a photo, send it by phone, and we'll have it and we're good, you know, so I can work that way. But we didn't
give everybody one. If their scholarships and amount they received in financial aid exceeded their tuition, we didn't issue one.
And is that still the case?
That is still the case.
Okay.
But it makes sense though, you're not paying for anything.
Well, I know, but ostensibly you might have some income you have to recognize if your scholarships and grants exceed. So, this gets us right to this discussion. So, we're doing American Opportunity Credit and we're looking for information, right? So, check out box 8. Check if at least half-time student. So, there's that answer, right, we were looking for. The filer's employer identification number, there's that employment EIN number for the college, university, whatever that we're going to find, and their name and address. All this stuff you'll be needing to input into TaxSlayer to activate the American Opportunity, to pursue the American Opportunity, the student's name, et cetera, et cetera. As far as the amounts go, and then it even has check of a graduate student. So if that's checked off, what does that tell you?
It'll have to be lifetime
Lifetime learning, no American Opportunity. Right? So the boxes we're looking at, now we're going to get into qualified expenses. I'm pursuing, let's say American Opportunity Credit for my example. And I'm going to be doing a comparison of 1 versus 5 to determine what the net would be between the two for a portion of my qualified expenses, right? So if payments received for qualified tuition and related expenses is, let's see over here, $2,500, right? And box 5 says the total amount of scholarships or grants. If that is $3,500, this came from box 5, scholarships, grants, right? Scholarships. And then box 1 was, then the difference between the two is 1,000. That is the amount of the qualified expense for the university. Take the difference because they got scholarships. That's free money. And they use that to pay. So they're not going to get $3,500 in my example as qualified expense. They get 1,000 because they had scholarships and grants to pay for that. They don't have to pay that portion back, scholarships and grants. If it were loans, that would be a different story.
Isn't that backwards?
I was just about to ask that.
Oh, I'm sorry. Yeah. I'm sorry. Thank you.
There's no.
Yeah. My bad. My bad.
That's our case of not sending them a 1099.
Yeah. My bad. I'm sorry. No wonder y'all were looking at me like, what did you eat for breakfast? No, I'm sorry. So if your expenses exceed scholarships and grants, sorry to throw you off there, then to the extent that expenses exceed scholarships and grants, that's the qualified expense portion from the university. To that amount, then through my interview, I'm saying, did you have books, laptops, anything else that was required by any of your professors? And we're going to add that and put the total number in as a qualified expense. Conversely, what I was saying in my original example, if your scholarships and grants exceeded your qualified expenses, then potentially that is income that the reporting taxpayer would have to report. But what we've always done at our tax center is ask what they use that other money for. And typically it's used for those non-qualifying expenses like room and board and those kind of things. And so if it's reasonable amount, we're not running it through income and just letting it be.
So if both your payment that you made is needed plus the scholarships and grants just to cover the cost, you only get the difference of the two?
You get the difference of the two. Yeah. So you get, you reduce this by the scholarships and grants. Because, I mean, it makes sense to you because that wasn't, you didn't really come out of pocket for that money.
No, I did. I paid my son's tuition, and thank goodness with little scholarships and grants, it covered part of his housing, but I actually paid that amount that's in my box 1 on the 1098T.
Right, but that was, so you would take the difference between the two.
Yeah.
If this was, and it should have been for tuition, qualified tuition. Yeah.
I had to pay for all his classes, but that covered like books and other things.
Well, no. So wait a minute. So let's say, what are you saying? This was
I paid like $3,500 for tuition at a university. Scholarships and grants was like, I think it said $1,700 or something.
Okay, so that's $1,800 that's qualified, and now you add to that books and any other expenses. Because books. The university doesn't know how much you spent on your books.
Right.
So that's why you get to add that. It's separate and apart. Okay. Everybody follow? Yeah, you're...
Do you need to report that exceed amount of, their scholarship, other expenses?
Yeah, that's what I was saying. It depends on what they use that money for. If it was used for college-related, non-qualified but college-related, we have, I've always been told just to let it be unless it's just a huge number and we don't force them to run it through taxable. But if it's a big number, just let's talk amongst ourselves and try and get an idea. But I mean, some of these private universities, the room and board is astronomical. And so, we'll sit down with a taxpayer and they may have to go get a ledger from the college to show us what all the expenses were just to make sure, that they just didn't pull money out and walk away with it, but that it actually went for those other college expenses. And all my IRS people that I work with have all told me just, let's reconcile it for them, make sure they have the backup and let it be. But it sounds like here at Brookhaven, they're not even going to send you this. Yeah. So that's interesting because I know we've sent several Brookhaven students looking for that 1098T because they
come to our office and say we're not giving you one because your financial aid, and we're specifically talking financial aid.
Yeah.
I mean, because loans wouldn't appear on here.
That's right. That's right.
But yeah.
Yeah. Is that true of all the community colleges in the system, or
in the DCCD?
Yeah.
The 7 colleges there, like Eastville, Central, they all have the same practice.
So that would explain why they can't find them sometimes. Then.
But it would be because it exceeded their tuition, so
Yeah.
they wouldn't have anything to.
Yeah, no, I understand.
Yeah.
I understand. But yeah, we can't even get into other expenses with them because we need to know how much it exceeded it by to see if that maybe covered the books and all of that.
Isn't there is another exercise in here somewhere, I guess it was under income maybe, in the advanced questions, about it being taxable when the qualified was less than Fox.
Yeah, I'd say yes.
But our students aren't getting that, so they're
Yeah,
not reporting.
but I think for the exam purposes,
Interesting.
yeah. But
Sorry, what if you, how you can save it for the later years? Like, let's say I'm part-time student this year and I want to use it for next 4 years. And my school gave me the 1098.
Oh, you got a 1098T?
But I don't want to use it. How can I do that?
Yeah, I don't think you can't. You'd have to go ahead and claim it,
Exact.
or you'll lose it. Yeah.
So you can only claim.
Or you know what? No, maybe what I would do, put it in a lifetime learning.
Can you do one or the
Yeah,
other?
do lifetime learning.
It's not about the school because the school didn't check that as a lifetime.
No, it's not about the school doesn't do the lifetime learning or American Opportunity. That's us by definition. I'd make the argument to the IRS that I was lifetime learning. I wasn't better than part-time. Because you're going to be working on your degree those other 4 years as well. Yeah, and just save it. You're not going to get near the amount of the credit, so you're not hurting. Yeah, I mean, you're not abusing the system as I see it. You're just taking non-refundable credit. And it may or may not help you too. That's the other thing. But save it for the full time.
I missed that. How many years can you claim the lifetime learning? Every year?
Yeah, no limit on the lifetime, but the American Opportunity is limited to 4. And you need to be working on that undergraduate degree during those 4 years, at least half time. At least half time. Yeah. Yeah, so I think that's what I would do on that. Okay? Let's see, what else? Yeah, again, I can't stress enough to you that you've got to have the 1098T as the launch point for American Opportunity Credit, or you won't be able to input your information. This is an exercise, one of your tests, is it Emerson or Donnelly? I can't remember. Emerson? Yeah, where you'll actually be working through education credit, and you have to decide, is it going to be American Opportunity or is it lifetime learning, and then you've got to input all of the information. Okay? Okay, so I'm going to go back to J5 just for a second. It says, who can claim the credit? Taxpayers who paid qualifying educational expenses of higher education for an eligible student. So remember, typically this is going on mom and dad's return. Okay? Because their kid is the dependent, their child is the dependent, and they're the ones that are away at university or college or maybe just going locally or whatever. But that's whose return it flows through, mom and dad. That's who's going to benefit. And then who can claim the credit? Taxpayers who paid the education expenses for a student enrolled or attending an eligible educational student. And the eligible student is either the taxpayer, taxpayer's spouse, or their dependent. Yeah. Qualified, and it says, note, qualified education expenses are considered paid by the taxpayer, paid by their dependent or third party on their behalf. So if your grandmother paid for them, it's a gift, but you still get to get that credit. Or grandfather. If a student isn't claimed as a dependent, only the student can claim an education credit no matter who paid the expenses. So as I say, so parents that have a dependent, they get the credit. Okay, anyone paying the expense, even directly to the institution, are considered to have given a gift to the student who is in turn treated as having paid the expense. Okay, how sweet is that? Thank you, Grandma. There are 2 4-year tests for the American Opportunity Credit. First, the credit can be taken for only 4 years. We've already said that. Second, the student must not have completed 4 years of academic credit before beginning of this tax year. Okay. And then we've already talked about who can claim a credit, who can't claim the credit? Married filing separately, filing status. See, there's another reason. The disadvantage of married filing separate. Can't take this credit. Anyone listed as a dependent on another person's tax return, we know that. Taxpayers whose modified AGI is more than the allowable income limits, we know what that is. Taxpayer was a non-resident alien for any part of the tax year. What expenses qualify? Expenses paid for an academic period starting in 2018 or the first 3 months of 2019. Expenses not refunded when the student withdraws from class, and expenses paid with the proceeds from a loan. So if you're using a loan to pay for this stuff, then it's still eligible, right? Because you got to pay that loan back. It's not like the grant for scholarship, which is the free money I referred to. What are qualifying expenses? It's expanded for the American Opportunity Credit to include course materials. For this purpose, course-related materials are books, supplies, and equipment needed for a course of study, whether or not the materials are purchased from the educational institution as a condition of enrollment or attendance. Okay, that's what we said. And then you get into tax-free educational assistance. Okay.
I guess I have a question about that. So this one's saying that the materials don't need to be purchased from educational institution, but then the lifetime one says it does need to be purchased.
Correct. Yeah, I made that distinction earlier.
Okay.
And it is a distinction. Lifetime learning, it's only materials that you bought from that same institution. Like beauticians and stuff like that, I'll see where they have to buy the course material. They have to buy their products and stuff from their from the provider. But we need to move on. So we're back in our discussion of credits, right? And non-refundable credits, we talked about child and dependent care credit, not to be confused with the child tax credit that I'm going to address next. We've talked about our education credits, right? And we know now that education credit, the most opportunistic is which one?
An opportunity.
Why?
Because part of it could be refundable.
Yeah, and the amount of the credit's more too. Yeah, 2,500 versus maximum of 2,000 for the lifetime learning, right? So you've got your tools there. So we'll even check this one off over here. Okay, so now I'm going to skip the order just a little bit, and we're going to jump into child tax credit. This is a most popular credit amongst our clientele. It's changed a little from the prior year, but basically this credit is, the ability to take this credit is dependent, and by the way, I'm looking in G12. G12 in your 4012. G12, page G12. Unlike last year, any child that is eligible for this credit now has to have a Social Security card. Used to be with an I-10 you could get the credit, but no longer. So the child has to have a Social Security card, and the child has to be under the age of 17. Okay, so up through the age. And the snapshot, and this one is taken at the end of the year, and it's all or nothing. Unlike our dependent care credit, where we said we could get a pro rata share of those expenses depending on when that child turned what age? What was the age limit on the child in dependent care? 13, yeah. Yeah. Here, it's 17, but the snapshot is taken at the end of the year, and if they're 17 or older, no longer eligible for that. Okay? So, qualifying child. I'm reading at the top of G12, under age 17 at the end of the tax year, a U.S. citizen or U.S. national, resident alien of the United States, claimed as your dependent, clearly, your son, daughter, adopted child, stepchild, eligible foster child, or descendant of any of them. B, brother, sister, half-sister, stepbrother, stepsister, or descendant of any of them. And they didn't provide over half or his own support and live with the taxpayer for more than half the year. Those requirements are all, remember we saw all that over in the determining whether they're dependent or not. So it's a repeat of some of those requirements as well. But the leading drivers in this are Social Security card and under the age of 17. Okay, so what they did do is they increased the credit from 1,000 to 2,000 for these eligible individuals. So that's good news. And so it, like the American Opportunity Credit, is non-refundable and refundable. And the maximum on the refundable side of this is $1,400 per child. That's why I put up here, max at $1,400 per child. Okay? And taxpayers are going to do all the math for us, take care of it. But if you're trying to trace numbers, that's what's happening. It's limited to $1,400. Okay, so in that second box, it says additional child tax credit. Let's see what the eligibility rules say. The child tax credit is generally a non-refundable credit. However, certain taxpayers may be entitled to a refundable additional child tax credit. Those include taxpayers with more than $2,500 of taxable earned income, if they have at least one qualifying child. Taxpayers with 3 or more children may also be eligible for additional child tax credit regardless of their income. And it's limited to $1,400 per qualifying child. It's one of the more, I think, cut and dry, because it's age thing and Social Security, and then, you know, taxpayer will do its magic for us. Okay? Yes, ma'am.
On that one, if you get the additional child tax credit $1,400, does that mean you don't get the other one?
No, just cumulative. It can't be more than 2,000. It's just saying that. So, and you may not get all the 1,400. It's up to 1,400. But the scenario that they're alluding to is that if your tax liability were 0 and you couldn't use, there was no non-refundable tax credits to your benefit anymore, because, let me put it another way, if your tax liability were already satisfied before you hit child tax credit, okay, then the most you're going to be able to get as an additional child tax credit is $1,400 per child.
Because I did the one, the sample one, and it was like under 5, I guess, what I'm saying. And so they didn't get the child tax credit, they got the $1,400.
Right, because probably their liability was satisfied through other non-refundable credits, or maybe the standard deduction was greater than their income, so they were at 0.
Oh, they had
0 tax liability, and so all they get is the $1,400 under addition. It's a really good point.
Where would you see tax liability?
Well, to begin with, we would see it on 1040. It starts with line 11, tax.
Okay.
That's the first time we see tax liability. And then it starts reducing it, and then it adds other taxes, and then it starts reducing it through first non-refundable credits and then credits. But yeah, so yeah, to your point, the maximum child tax credit that you're getting in that circumstance is $1,400. So they didn't get the $2,000 because there was no tax liability, and you couldn't apply the any non-refundable portion. Okay.
If you have 0, it won't make it negative, right?
It what?
It won't make it negative.
No.
If you have,
No, 0. Yeah. Yeah. If you would, the negative would come in the, you could call a refund a negative number if you wanted to, because that's money out. Yeah. But anyway, the max you're going to get, the additional child tax credit is $1,400. Okay, and you're going to see that. Which scenario did you say that was? Is that the Emerson's?
Yeah, I think it was the one before.
Yeah, scenario 5. So scenario 5, you'll see when you do that the maximum child tax credit you actually received, your client received, was the $1,400, because the balance of it wasn't. Yeah, it went towards the refund, but the balance of that wasn't useful to them because they had no tax liability. There's nothing to apply it against. Okay, so that, in a nutshell, is child tax credit. Everything else there is. So let's talk about the credit for other dependents. So anybody else that's a dependent and didn't qualify for the child tax credit, they could potentially get you a non-refundable credit of $500. So that would include maybe you have a qualifying relative. Or first off, it includes children that are what age and older? 18, 17. Children that are 17 and older, that are your dependent, and have a social, they would be eligible for $500 non-refundable credit, called credit for other dependents. So it's the converse, right? So we covered the ones that are under 17, so now you got kids that are dependents. Over 17 or older, they potentially can get you $500 non-refundable. And then any other qualifying relative that you have, right? Including folks that have an I-10, but they have lived with you at least 6 months, they could get you $500, make you eligible for $500 on a non-refundable basis. So that was one big change, like I was saying earlier, that Congress made in the tax law. They really narrowed who could get the child tax credit, or the bigger amount. But it did go from 1,000 to 2,000 on those that are eligible. They just refined the eligibility. Okay, so that's the credit for other dependents. Let's see if it says anything. I'm looking at G14. It says there is a $500 credit for other dependents who do not qualify for the $2,000 child tax credit. The dependent must be a U.S. citizen, U.S. national, or resident of the U.S. The dependent must have a valid I-10 or Social Security number. The $500 non-refundable credit is available for dependents who don't qualify for the child tax credit, such as children who are age 17 and above, or dependents with other relationships, such as elderly parents. Taxpayers cannot claim the credit for themselves or a spouse if married, filing jointly. And it says right there, dependents who are residents of Canada or Mexico do not qualify for either the child tax credit or credit for other dependents. Okay. Like I say, to me, it's pretty cut and dry. Okay? Any questions? So we did that one. Retirement savings contribution. Miscellaneous credit. So, gladly, gratefully, I like this one because to the extent someone is contributing to a 401k, and it phases out depending on AGI thresholds, but most of our some of our folks are qualified for it. But basically, the non-refundable credit will kick in, and it's a percentage of, I think it's 10% of how much they're contributing to the 401k. How would you know if they're contributing to the 401k? Taxpayer is going to do all this calculation for you. But by the way, on your W-2, under box 12, you would see a code D. D is in Delta. And that would tell us that they contributed to that. And again, depending on if they exceeded the threshold or not, we'd see some credit come to them for that non-refundable credit. Yeah, contributions to non-taxable accounts such as a Roth can qualify for the credit as well. So that's pretty cool. So it's not just pre-tax.
So say that one more time?
Contributions to Roth would qualify as well.
Qualify for what?
For the tax credit. Okay. Yeah, because remember how we talked about pre-tax versus after-tax, but even a contribution to a Roth would trigger that, could potentially trigger that credit for a client. So that's good.
So I'm sorry, I need clarity here.
Yeah.
So if you're donating to, or if you're contributing to a Roth, you get a child credit?
No. We're talking about retirement savings contribution credit. And all I'm saying is that even if you contribute to a Roth, you could ostensibly get that credit.
Okay.
Typically, it's given, because you're contributing to a 401k or an IRA. And so I'm just saying also Roths are included. Okay. So that's that one. And then this final one, I don't even think we cover it because it's been winnowed down over time. The residential energy credit used to be much more generous and open as to what it would cover, windows, air conditioning units, etc. And now it's very specific, and the total amount of the credit, I think, is only up to $250, as I recall. And it's very, very specific. I've seen it a couple of times, but if somebody comes in and is asking about that, let's huddle with your site manager, and we'll look up, you know, what the restrictions are, what the qualifications are. But it has to be Energy Star. They have to bring the invoice, the original invoice for the equipment. You have to have all this information for them to qualify for that. But we'll talk about it if it's something they've done. But like I say, a lot of people still remember it from the old days when it was really generous, and it's been narrowed somewhat. Okay, so that is our non-refundable credits, and we've talked about additional child tax credit. So I'm going to talk next about the earned income credit. We're now into the refundable credits, full refundable credits. And I'm looking in tab I. This is a credit that we want to make sure our clients, to the extent they're eligible for it, are getting it. Because it's not, there is no income test on this one, and so it can often end up with money in somebody's pocket, you know, depending on what type of income they have, and they may not think they're even eligible for it. They don't think they made enough. They don't think, you know, that it would be coming to them, but in fact, EIC is there. It's, I guess, my understanding is Congress set this up kind of as a safety net for people, and it's a way of to give lower income, especially lower income people, help. And what happens is that income phases out as their earned income goes up, then the amount of the credit that they could get drops until at some point it just disappears. But the potential of the full credit can be up to $6,600 this year. Depends on what your AGI is, your earned income. It depends on how many qualifying individuals you have living with you, qualifying dependents. But TaxSlayer will do all that for you. But $6,600 is a good amount, right? Not something you want to walk away from if it's coming to you. So we just want to make sure that you know, our clients are getting that to the extent they qualify for that. So what is this? This earned income credit has various eligibility requirements, and again, I'm looking at I-2 in your 4012. By the way, you can be single without children and qualify for this credit. And that's often a misnomer. People don't catch that. But you don't have to have kids necessarily to get this. The more children you do have, then the more you possibly get from the credit. And then also, we'll see where age does kick in as to whether you're eligible for it or not. But I'm looking again at I-2. And the requirements are as follows. The rules for everyone in column A, as you can see, is everybody has to have a Social Security number. If one person has an I-10, game over. Nobody gets it. Okay? And so I think I may have been telling, I may have said last week, I was talking about the gentleman that was sitting out in the waiting room, and his wife was having her tax return done. And come to find out, she told us she was not married, and so was going for head of household with 2 dependents. But in fact, she was married, and I discovered that in talking to him. The reason she was doing that is because he had an I-10. Everybody else had socials. He had an I-10. So by, you know, coming together as a married couple, they wouldn't have gotten this EIC because his I-10 would have kicked him out. You see what I'm saying? And so, yeah, it hurts. So that's why she was presenting herself as head of household, and it was again, through my questioning, that I realized, I'm sorry, but you are married. In terms of the tax law, because when I got them together and we discussed it, you are married, and we either do married filing jointly, or, as I said, married filing separately. You'll decide. And I mean, she immediately knew what was going on, because they understood what the, you know, how the law was written. But so they left, and that was their choice to do that. But I don't know what she's going to do at the next stop. Maybe she won't take her husband next time. Leave him in the car, not have him. Yeah. But yeah, so everybody's got to have the Social Security card to be eligible. Yes, ma'am.
So why you explain to them? Did they ask you why they are not getting the credit for this?
No, I didn't. You know, I left it to them. I just said, you've got to be married filing jointly or married filing separately. They knew. They understood how it works.
They knew.
Yeah, they knew. Otherwise, why would they have presented themselves as not being married? Yeah. So, I mean, yeah, that's all I needed to say.
for the EIC.
Yeah, I know. But I didn't get that far with them. We were stuck on their married filing, their filing status. We needed to get that correct. But I know that's why they were doing it, because they knew full well as long as he had an I-10, they weren't going to get the EIC, and they're wanting they wanted the EIC. Yeah, I know. So in that case, I feel confident that they knew. But anyway, to my point, my point is everybody's got to have a social for that, and you have to have the social now or by April 15th, because it used to be you could go. You say you're working on getting your social, your I-10, you get your social, then you could go back and do 3 years of amendments and get that earned income credit by amendment for those prior 3 years. But no longer. The government knocked that out. They won't let you come back in. So, you know, that's a real disappointment for people, because up until 2 years ago, you could go back and do amendments and get that extra credit if you got your Social Security card, once you got your Social Security card, or whichever, you know, individual didn't have the Social Security card. Okay? So Part A, rules for everyone. Filing status can't be married filing separately. There we go again. Another reason why married filing separately is a disadvantage. You can't qualify for this credit if you're doing married filing separately. Even though everybody has Social Security cards, if you're doing married filing separately, no EIC. So that goes out the window. Must be U.S. citizen or resident alien. Can't file 255. That's related to foreign earned income. Investment income must be $3,500 or less. And we're talking about interest, dividends, that's stocks. That's what investment income is. And you can't be a qualifying child of another person. Okay. If in fact you have a qualifying child, then that child must meet the relationship, age, residency, and joint return test, but not the support test or the income test. The age is the same as our dependency age rules. And the dependency age rules for qualifying child, do you remember those?
19.
Huh? Go ahead.
19.
Is it up to 19?
And 24, they're living.
If they're student, let's go look. Where are you going to find that? Tab C? Yeah, under 19 at the end of the year. Under age 24 at the end of the year, a full-time student, or any age of permanently and totally disabled. Right? Same test. Same test that we saw in C1 applies to the EIC. One of your test questions, red alert, is being driven by this. There's a question of who all is eligible for the EIC in the family. And you've got, was it a brother?
No, a child and a grandchild, I think.
Yeah, but there's one of them where you have a brother who.
Oh, one has the I-10 and one has.
Yeah, maybe it's 5. Maybe it's the 5th scenario. He's an older guy, older brother that lives with them, that he's permanently.
Oh, okay, yeah, I think that's the first one.
Well,
Emerson.
it's a qualifying child, that's right.
So it does not apply on the other part, it's only the qualifying?
Well, but it could be a qualifying relative as well. If they just have to meet all these tests: relationship, age, residency, and joint return. Okay. Then if you don't have a qualifying child, these are the single folks, or not just single, but married, filing jointly. Then you must be at least age 25, but under the age of 65. So there's an age limitation if you're without children and applying for this EIC. So yeah, remember we talked about how we can do tax returns for individuals, typically students, that are dependents of their parents. And we're doing that just so they can get their federal income tax withheld, as much of that back as possible. And so you are not surprised you won't see an EIC credit in that because they're under the age, even though their income is so low. And you would think, hey, they got a social, they didn't make anything, they should get an EIC. But what's triggering them from not getting that, what's stopping them from not getting that, is this age thing, because they're under age 25. So the EIC is only good for individuals that are between the age of 25 and up to 65. And then, again, TaxSlayer does all this for you, but these are the, Part D is your earned income and AGI limitations. You must have earned income to qualify for this credit, and your earned income and AGI must be less than these different levels. And again, TaxSlayer is going to do all that for you. But again, this would just tell you why, if you're thinking, there should be a EIC here, why isn't it? Well, this will help you explain. Or maybe they got it last year. I mean, that's typically the scenario, right? They got EIC last year and they're not getting it this year. And you know, we've got to explain to them what happened. So these are the tools we have to figure out. But maybe their income went up. Yes?
So in Part B it says, test, the child doesn't have to be your dependent?
The child doesn't have to be your dependent.
So they can file their own return, and then you can, how do you do that?
Let's see. Child must be relationship, age, residency, and joint, but not the support test.
So do they file their own?
Yeah, so they would have possibly filed their own return as well.
But they will be dependent of you, and you will claim them only for that?
You just claim them for EIC purposes. That would be their own, but you would claim them for EIC purposes because they met these tests.
But how would they file? Like they would file
Single.
like a single dependent?
They don't have any dependents. They're just single.
Single?
Single, yeah. They would just be a single.
But they will say they're single, but they can be claimed as a dependent of someone else.
Yeah, well, they wouldn't be a dependent. For EIC purposes, they're not a dependent. They're just EIC qualified.
Oh, okay.
That's
so
all.
So there will be a tab for that.
That's right. We would say they can't collect EIC because this person is collecting their EIC. So you can't double dip either. But there would be a box we would X off on that case for that person. It's confusing without seeing the actual software. But yeah, we would put them in that way.
They always do that. Sometimes when there's a child and they have to file by themselves, we check mark that if their mom or dad
claim them as a dependent. Absolutely. In that case, you put down that they are dependent on somebody else. If they are dependent.
Just in this case, we don't do that?
Well, no, what I'm saying is that, I mean, it all depends on the scenario, right? But what we're talking about is who's eligible for an EIC. And so you can have a scenario like you're going to see, I think it's in the Emersons, where her brother lives with them. And he is permanently and totally disabled. And his earned income is less than the $3,500. So for purposes of the EIC, he can be added to her head count. So he's considered a qualified child for purposes of EIC, not for other child tax credit and other dependency. It's specific to this particular credit. It's confusing because they use the same terminology, and you're qualifying children versus qualifying child and all of that. But there are scenarios where you could possibly have a person that's not a dependent of yours be considered in the head count for your EIC calculation, as is the case with Emerson. Once you work through Emerson, you'll see that and see how it's input. Okay, but yeah, that's one exception. Let's see, what else was I going to say about?
And how much is the earned income credit?
Well, it varies, but that's what I was saying. The maximum it could be, last year was like $6,600. Yeah. But that would be maxing out, you'd be at the lower end of the AGI limit and at the higher end of the kids. That would get you that. Because like if you're single, I think it maxes out, I'm guessing, but I think I remember the chart saying like 3,000 or 2,800 or something like that. So you'd have to be married, filing jointly with lowest amount of income and a greater number of kids to get that, the full boat. Okay? Yeah. So, yeah, so I know I don't think I did a good job of explaining to you, but the definition of a child for EIC purposes includes somebody at any age as long as they're permanently disabled in this particular case. That's not
disabled. So, I'm sorry, and maybe if I go to the case I'll understand, but I still don't understand how, if you're gonna put a family, mom, dad, 3 kids that you're claiming.
right.
But maybe, okay, when you put 2 kids that you're claiming, but then the third
There's
one
a third.
is 23 and is having a full-time or a part-time job and is earning their own income.
Mhm.
So he's gonna put his income file his income as single, but you
Mhm.
are gonna claim him for the EIC credit?
Potentially, yeah, you could still claim.
But where does it fit into your?
You'll put him in as a dependent, but then there's a box you'll check. Use this dependent only for earned income credit purposes.
Oh, okay.
And so it limits how he impacts.
And he will have some place where you'll say, he is claimed as a.
Yeah, it doesn't even go that far. It just says limit him for earned income purposes only.
Oh, okay.
And then he goes and does his own tax return and all that. But then that way, it can be included in the parent's tax return for earned income credit purposes only.
Okay.
So that's how it
That
limits
makes
it.
sense.
Yeah.
In her case, she said the child is going to be 23 years old, and maybe they can apply for EIC. And it doesn't matter if it's 23 years old, because you said the age it should be.
Yeah. So in that case, if it were 30 years old, then it'd be any age, and they'd have to be permanently disabled to
So
be able to follow that.
The person that you claim as dependent should be between 25 to 65, not the taxpayer.
No, that 25 to 65 is as it relates to the taxpayer that can get the EIC. Yeah, the qualifying child has no age limit if they're permanently disabled. Okay? But it's just for the EIC. The EIC is like the separate test that it has.
So you don't qualify if you are between 25 and 65 or 60?
No, if you're less than 25 or older than 65, you're not eligible for the, and you're seeing, yeah, for the EIC. That's what this says.
Okay, so her question kind of was, and I'm now a little confused. If you have that student that still the person that lives with their family, but they're 23, they're working their own full-time job, and they make $30,000, so they can't be on their parents as a dependent, but because they live in the house, they can be their EIC?
No, because they're not
Okay.
they're not fitting the age test.
There's an age test for
Yeah,
EIC.
yeah, that's what I was just
Okay,
saying. Yeah, remember?
Disabled, there's no limit.
No age limit, but the age test includes.
It's 19
Under 19.
Under 19 or up to 24 if you're in the.
Under 24 if you're a full-time student, or any age if you're permanently disabled.
Okay, that's the thing that wasn't clear.
Yeah, yeah. It has a whole separate age test. It just happens to mirror the dependency test, which age test.
You said
But they're-
23. There was an example.
Yeah.
It could be 21 or.
Where'd you find age?
Oh, I just know it.
Oh.
It's in here. No, if you go through the, I-4, you'll see the age test. Yes, question?
Wouldn't that apply mostly to the box that you check, like when they're separated, you know, like when one spouse is claiming dependency and the other is.
No, but if you're doing married, filing separate, you can't even apply for this EIC. Remember, we just said that.
No, I meant like when they're divorced and, you know, they have where somebody can claim some of the credits and they.
Oh, if they're divvying things up?
Right, when they file an agreement where somebody can claim, the EIC and another one can claim.
Yeah, that, you'd have to follow the divorce decree, right, and see how it's going to be split. Okay. Okay. So that is, again, the EIC is a calculated amount by tax layer. These are all very good questions because, like I say, there will be, especially those situations where they no longer get it, and that predominantly is where the conversation comes up. And two, when I'm reviewing my tax returns, I'm looking to make sure that if they're due an EIC, that it's there. Because if it's not, then we're going to go back and look at our inputs and make sure that we did everything correctly. And that the amount, and I even have a table that I keep which has a schedule of all the potential amounts depending on what your level of income is, et cetera, that I'll even use to check if I need to, because it's a very important credit. I-6, disallowance of certain refundable credits. This Form 8862, and we really see this mostly when after we've e-filed the tax return. Sometimes we'll get a reject from the IRS, and it's because they'll say this Form 8862 wasn't included, and all that is saying is that sometimes in the event a taxpayer is denied EIC or even additional child tax credit because they wrongfully received it, and then the IRS through their checks determined that they didn't qualify. Then for the next, 2 years? Yeah, IRS determined a taxpayer claimed the credit due to a reckless or intentional disregard of the rules, not due to math or clerical errors. The taxpayer can't claim the credit for 2 tax years. If the error was due to fraud, then the taxpayer can't claim the credit for 10 tax years. So it behooves us to make sure that our taxpayer is doing the right thing and legitimately claiming these returns, because they can get themselves into a whole lot of trouble. And it's my job is to make sure I get all the facts, ask as many questions as I need to, ferret out the husbands waiting in the lobby, you know, because I don't want them to get in trouble. I mean, that's part of our mission, right? We're going to do an accurate return. So that's why I make it my business, you know, to know their business within realm, within reasonable realm. And again, if you're ever uncomfortable or feel something's off, you just step aside and come talk to your site manager and let them help you get through something. So, and that scenario I painted is very much in the minority. Typically, you know, that's not something that comes up, and somebody more senior would be on top of it. But you just need to be aware of that. You know, I think the biggest issues that come up with our taxpayers is you have somebody come in and they have, what, $1,000 of income, and they're trying to claim 3 people, and they want this earned income and all that. And so, what does that make you think? Who can live on $1,000, much less have 3 dependents, and live on $1,000, right? So that's when we just sit down and I will talk to people and just say, okay, what's your monthly budget? How much you paying for rent? how much you paying for utilities. You're telling me you get 1,000, you know, so I know, divide that by 12, that's 100, what, $80? So how are you covering the rest? Oh, child support. Okay, that's child support. Oh, I get food stamps for my food. Okay, cool. So then we tell the story and we start to get comfortable that, yeah, it's legitimate, right? And that they can, or they get a gift from a grandparent or relative, or they live with relatives. All of a sudden, you're like, oh, you live with relatives. Okay, well, who's in the house? Let's make sure we don't have too many head of house. We can only have one head of household here, right? So we need to walk through and understand that. So it's these questions that can, you know, like the onion unpeeling book gets a little, you know, more interesting as you walk through those things. But it's those type of things right up front that should make you stop and ask questions. And we're not the auditors, and I'm not there to accuse anybody of anything. I'm just trying to get information and make sure that I'm presenting your tax information in the best light. If we do that, you know, we've done our job. And then we're dependent on them telling us the truth. If they don't, then that's on them. Okay, so that's EIC. So we have covered all but the healthcare section. What time is it? Oh yeah. So I'm going to blow through the Affordable Care Act as much as one can run through that, and then we're going to break for lunch and then come back and do some global commentary and then get you back working on your exercises, because I really want to get you guys through as many of those tax returns you need to create as possible while I'm here with you. So the Affordable Care Act. Is anybody here familiar with the Affordable Care Act? Have you bought your insurance through the marketplace? Raise your hand. Anybody? Yeah, I have. Yeah, okay. So some of y'all have touched that. Well, for those of you that aren't familiar with the Affordable Care Act, this was legislation that was enacted back in 2014. And basically, what Congress said, it's affectionately known as Obamacare. You may have heard it called that. The marketplace is another name for it. But basically, under this law, everybody has to have minimal essential health care coverage. And it's a defined term. And not all plans are created equal and meet that requirement or that definition. Oh, I'm looking H5. Thank you. Yeah, and I'm just talking generally about it, and you'll follow through. So H6 has the types of minimal essential coverage. And there's, I think it's like 75% or 70% of Americans are covered by an employer-sponsored coverage plan. And that is, you're working for you're working for wages, you work for a company. It's a huge percentage of folks, all 350 million of us, that are mostly covered by an employer-sponsored plan. And they changed their terms, which is a really good thing about Obamacare that came about, was that Obamacare expanded things like you get a free physical, women get, exams that weren't normally covered for free as part of the package. And corporate America, and also you can keep your kid on your health insurance now to the age of 23, where it used to be, I think, 19, or maybe it's 26 now.
It's 26.
26, yeah, 26 now. And all that came because of the Obamacare legislation made that available. So thank goodness corporate America copied it and expanded their provisions. So good things out of that. But anyway, as I was saying here, most people have health insurance through a group health plan that comes through the company where they work or their spouse works, right? But you can also buy individual health plans. And so that's either directly from an insurance company, like I used to buy mine directly from Blue Cross Blue Shield, because when I stopped working for a company, I had to go out and find my own insurance. Or you can buy it through the marketplace from Obamacare. If you can't get it from anybody else, you can go to the marketplace, and depending on your income and whether you have any insurance available to you, you could qualify to buy your insurance through the marketplace. And the thing about the marketplace is that it comes with a potential subsidy. So, you know, when you buy health insurance, you pay a monthly premium, and through the marketplace, depending on your income, you could qualify for help. So if your monthly premium was $900, you know, ostensibly, for instance, you pay $300 and the government pays $600, provided you meet these income tests. So there was that. Individual health coverage could also be provided through a student health plan. We have a lot of our clients who, does anybody here on the student health plan? I don't know if Brookhaven, you are? Yeah, I don't know. Does Brookhaven offer that?
I don't think so. They direct you to people.
They direct you to people. There you go. Or there's catastrophic coverage, which means you have this huge deductible, and it's just a last resort kind of thing that would cover you if everything went bad. Or there's coverage under government-sponsored programs, and the ones we see more often are Medicare. And Medicare typically applies to folks that are 65 or older, but you can be younger than that under certain circumstances and qualify for Medicare. In fact, there's a lot of, you'll hear this amongst the presidential candidates, especially the Democrat Party. They want to expand Medicare because now you can't qualify for it until you turn 65, right? And they want to lower the age and bring in more people, especially the 55 to 65 group, who has the hardest time finding insurance just because of their age. Medicaid coverage. Medicaid is for lower income folks. CHIP is the Children's Health Insurance Program that's here. I think it's just here in Texas, but it may be nationwide, I'm not sure. But a lot of our clients will have CHIP coverage for their kids. And then there's Peace Corps volunteers and some others. Now, what isn't covered, by the way, is everybody's familiar with Parkland Hospital here, right? The big community hospital. And they offer medical plans. It's really a discount program, so you get certain services. So it's, you know, it's very limited, though, and it doesn't meet the minimum essential coverage. So oftentimes people will come to us and say, I've got Parkland, and we're like, unfortunately, that doesn't qualify. That doesn't.
What about JPS and Tarrant County, John Peterson?
I would say.
I think theirs does.
You think so?
Yeah, I'm not sure if people live in Tarrant County.
Yeah, we don't see anybody.
They have a health care available, they have their own clinic, but I think it may.
Yeah, because like I say, the trick is, do you get free physicals? Do you get, you know, can you put your kids under?
You know, and it depends on like your income too. That's where like your co-pays and stuff. It's all like sliding scales. But,
yeah, but it's a question of the services they provide.
Yeah.
Yeah. So anyway, so that is what the minimal essential coverage is, and so everybody has to have that now. And heretofore, and I say heretofore because 2018 will be the last year, if you did not have health insurance coverage through one of these sources that we just talked about, then you would be subject to a penalty for any month in which you didn't have qualified minimal essential coverage health insurance.
So if someone says that they're under the Parkland plan, they don't meet?
They don't meet MEC. Parkland doesn't meet MEC. That's right. So the definition of coverage for any 1 month, by the way, is 1 day. If you had coverage for 1 day in that month, then for MIC, then we can say you had coverage for that month. But anyway, so the way the legislation was written to incentivize people, especially you younger ones, to pick up the health insurance, because if we get the young people in, they don't go to the doctors very often, was the mindset, right? But they're still paying their premium, and they can help cover the losses for all us old guys that do have to go to the doctor maybe a little more frequently. So, but as of this year, they're dropping the penalty. So going forward, no more penalty. But through 2018, and that's why we're even having this discussion, two reasons for having this discussion. One is because there's a potential penalty that your client or any of their dependents may have to pay. And secondly, as you'll recall, if you buy your health insurance through the marketplace, through Obamacare, I said that you could possibly be eligible for a subsidy, right? It's a tax credit. But it's a subsidy that will help you pay your premium. And so what happens is when you apply to the marketplace, one of the questions they ask you is, how much do you think you're going to make this coming year? So like when I applied to the marketplace last, what was November, December, one of the questions that I had to fill in is, how much do you think you're going to make? And I told them, and then they said, okay, based on that, then you are eligible for this monthly amount of subsidy to help pay your premium. Okay? So now what happens though, here I am at the end of the year, I'm getting ready to file my tax return, and through the tax return, I will determine how much I actually made. And based on that figure, I either may be eligible for more subsidy if I made less than I thought I did. If I made more than I thought I was, then I may have to pay back some of that subsidy. And so all of that was pushed into the tax return. And it never had been there until this 2014 legislation. So that's why, the second reason why we're having this discussion. One is to calculate whether a penalty is owed, whether you incur or taxpayer incurs a penalty for he, she, or any of their dependents, spouses not having insurance every month. And secondly, if they bought their insurance from the marketplace, from Obamacare, then we got to do this reconciliation to see if they're due more subsidy, payback subsidy, or it's a break-even kind of scenario. So big picture, that's what we're doing. Okay? Questions, thoughts?
How much is it?
Yeah. So the penalty. Good question. The penalty started at the greater of, I think it was 1.5% of your AGI, or $95 per adult, and half that amount per minor. Then it went up each year, where now it's ultimately the greater of 2.5% of your AGI, or $695 per adult, and half that amount per minor. The first couple of years, people were like, "Oh, I'll pay the penalty," you know. Ding me with $300. You have one adult, two adults, that's $200. A couple of dependents, that's another $100. $300, I'll pay the penalty. No issue. But as it started going up, then it was incentivized. It was hurting more, especially if you got caught in the greater of, because your 2.5% could carry it over the flat rates, right? So what has happened though, in addition, so that's the answer to your question. In addition, in the legislation, they included a myriad of exceptions where you could get around paying that penalty. And we'll study those briefly. Because actually what's happening now in 2018, so we're told, we're pretty much giving everybody an exception. Even if they were otherwise having to pay a penalty, we've got an exception now, hardship exception that will give them and turn off that penalty. That wasn't true in the prior years, but this year they've pretty much come out and say, IRS is not enforcing the penalty, is what we're hearing. And a lot of that is the current administration. When they came in, they've been trying to get rid of the marketplace ever since they arrived, and they got one vote short of totally doing away with this. But what they did manage to do was get rid of the penalty starting in 2019, and for 18, I'm going to show you the exemption to use so that none of your clients will incur the penalty. But we still have to do this exercise because we've got to reconcile for those taxpayers that took the subsidy, that bought their insurance from the marketplace. We still have to do the reconciliation. Okay? Question? Okay.
So, I'm sorry.
Yeah.
So, there has to be some sort of threshold, right? For the
To get the subsidy or the penalty?
The penalty.
Yeah, no, the penalty is off or on whether you had it or not.
Even even if they didn't make so much.
Well, there's exceptions, and yeah, some of the exceptions are income driven. You're right. You're absolutely right. That's one of the many.
I mean, because
exceptions.
that's the reason why people qualify for Parkland, because they're in the middle of the bracket of Medicaid and.
Gotcha.
You know.
Yeah, yeah, but that's a whole different qualification process that I couldn't address. But I can tell you, you're right that some of the exceptions are income based, and we'll see those. Okay, so that being said, let me go through the necessary forms. So number one, how are we going to know what their health insurance coverage looked like? What was their health coverage insurance? Huh? The interview, but specifically where?
The 295.
Yeah, well, get your intake sheets out. Everybody get your intake sheets out. Yeah, what page is that? Look at page 3 of your intake sheet. Everybody got that? Is it part 5? Yeah. Is it part 6 or part 5? It's part 6. V1, 6, yeah? The old Roman numeral. Yeah, so there we go. They're starting to answer those questions. Have health care coverage. Receive one or more of these forms, 1095B and 1095C. The 1095B is the one that, 1095C, excuse me, is the one that the companies issue. They're supposed to send that to all their W-2 employees, and we could see that as form. So the thing about this whole interview process of whether or not they have insurance is one of multiple layers. If they don't happen to have the 1095C, then I'm just saying, okay, I'm going to look at their W-2, and if I see in box 12 a DD, that tells me that there was deductions taken for health insurance. So there's proof. I also will say, did you have health insurance? Yes, yes, yeah, okay. What insurance company? Aetna. Okay, do you happen to have your card with you? And then I'll look at the card as another way of proof, right? Just make sure it's effective for last year and not the new one for this year. So, you know, we're going with them on this one. And so, I don't have to have a policy or anything like that, but I just want to feel comfortable. Yes?
Does the deductions, like the monthly deductions from like a W-2, does that qualify for the 7.5% for medical expenses?
If you itemize. Huh?
It also depends.
Yeah, it depends on who's paying them.
Okay.
Yeah. Yeah, but again, yeah. But whether that actually is going to benefit ours, our clients, as we said earlier, is probably not going to be the case. But yes, to answer your question. Healthcare premiums due?
It depends on who's paying it. So sometimes when you see the DD, it includes what the employer paid. So if you had to pay something over and above, which could come in with your 10% medical over there.
Yeah, that's
you
the
have
portion.
to know what that is.
Yeah, that's the portion. It's the amount over which your employer is paying on your behalf. Yeah. Okay. I forgot what I was saying. What was I telling you? Oh yeah, so we were looking at the intake sheet, and we were establishing which months they either had or did not have health insurance, because we're going to have to input all of that into TaxSlayer. Very detailed month-to-month analysis. Did you have it? Did you not? They'll sit there and they'll say, I don't know. I'm like, you got to come up with something. Well, my child was on CHIP and then I didn't renew it, and well, when did they have it? Well, okay, it was January through July. Okay, January through July. So they didn't have it the other 5 months, so fine, that's how we're going to mark it down. But they're going to give us all this information. And hopefully we'll have, like I say, the 1095C, which would tell us specifically which ones they have it by their employer. Sometimes they don't have that, and we'll go with a verbal. The 1095B, the Medicare would be on the Social Security. If they're getting Social Security, you may have noticed there's a deduct for for Medicare, and that would be the proof there that they had that. And we could see when they turn 65, and you know that's when that kicks in. So there's a lot of different ways to get around that, get that information. So if they say, one of the questions is, did you buy 3A, have coverage through the marketplace? 1095A. That's the one we have to have, because that's the form that is going to tell us that we're going to have to input into TaxSlayer, and that will be the basis for the reconciliation as to whether they got too much subsidy or getting more subsidy back. And if you look at H23, you'll see a sample of a Form 1095A. And that is issued to those folks that are that have purchased their insurance through the marketplace, by the marketplace, and they should have it by now. If they don't, not to worry, we've got blank forms on site, and we'll put them on the phone to the marketplace, and they can capture the information and write it in for us, and we'll have it there. Because I can't finish their return without the 1095A. It is critical. It is absolutely, necessary to do. And they have to file a tax return. If you took that subsidy, if you got that credit, you have to file a tax return in order to do this reconciliation. So they are obliged to do that. That's part of their contract with the government for getting that subsidy. Okay? So with that 1095A, then and marking which months they had or did not have, then we finished that part of the input. And then the next part is to figure out, now we need to isolate, okay, those months they didn't have health insurance, what are the potential exemptions, right? So, and I told you, we're not going to charge, end result, nobody's going to incur a penalty this year. But the types of coverage exemptions are on H15. Everybody look on H15. And there's really, if you would, there's four buckets of exemptions. These are exemptions for non-health insurance. I would say health insurance exemptions. The first one is, and I'm going to refer to that sheet here in a second, but the first one is a certificate number. If somebody applies to the marketplace and they're declined for whatever reason, they'll send them a letter. And that letter has, I think it's 7 alphanumeric digits. And we just put that into our input. And that takes care of everything. Because they applied, they were declined, but they would have that letter. So it's a letter form that includes an exemption certificate number. The second, and TaxSlayer does this one for us, is income is below filing threshold. And that would, again, flow through TaxSlayer. Based on all the income inputs that we put in, it would be an automatic. And that's covered there in that first line, income below filing threshold. It says no code, see Part 2. So that's an automatic one. The third one are what I'll call A through G's, which are detailed, or excuse me, H actually. Yeah, they added one. A through H's, right? And the fourth one is going to be hardship. And the A through H's are based on our interview. And so the most popular ones we see are short coverage gap. You went without coverage for less than 3 consecutive months. And this test alert, one of your scenarios, I think the mom and the son had insurance for 10 months, but not for 2 months?
They don't have insurance for 3 months.
3 or 2?
No, 14. Sorry. 2 months. 2 months and a half.
Yeah, 2 months and a half.
Yeah, so you give them you give them 10 months because they had it for at least 1 day that last month. Then you give them, so they had a total of 10 months coverage, 2 without.
2 and a half. Yeah, so they consider 2, right?
Well, it's 2 because, like I said, the half will cover the 10th month, right?
The half doesn't count because it was at least 1 day.
Yeah, just 1 day, right? So, but there's the exemption you can use, short-term coverage gap, and it's B. And it's actually in TaxSlayer. They don't use the letters, they don't use the code, they use the narrative, they use the descriptor. So it says coverage, short-term gap, I think is what it's called. So the other popular one that we use is for I-10. People with I-10s, they get C, citizens living abroad. If they have an I-10, don't worry about it. No insurance, we just put in that exemption, okay? The other one you'll see a lot of is G. And if you can't find any other one that works for them, use G, general hardship. That's the fallback. But if you can use one of the other ones, use it first. But if not, use G, general hardship. Okay? And that'll take care of us. So the only other one I will point out is H. It says household member born, it says member of the household born or adopted or died during the year. So it's those years, those months, when that individual was not here on this earth, whether because they were unborn or whether they were died. It's those months that you have to cover with H, right? So man dies in June, he had coverage January through June, but you need to put that exemption in for July through December. Even though he was deceased, we still need to put that in. Okay? So that is that. By the way, then there's these other hardships down at the bottom, and that's what we're picking up on. So, but that is the game. That is how we deal with our exceptions. So again, nobody should walk away this year with a penalty, because we have the tools to turn off. We have the tools and know which exemptions to choose. Okay, but when you're doing taxpayer input, don't forget you need to do the healthcare module. And in the left column, it's a different line item that comes down below. But we're not, now that you know health insurance is part of the conversation, you need to go touch that part of the module too. You always do that, okay? Make a point to include that. And probably some of y'all are off on Donnelly maybe because you didn't know about this exemption for those 2 months, right? And so now you do, and you can go back and hopefully if you're off on your refund, that should clear it up because you're probably being hit. So, I'm out of whiteboard. Darn, we didn't want to lose this. So, right here. So, the final thing about health insurance that I want to discuss, and then we'll break for lunch, is where it impacts the tax return. Because remember, we did this reconciliation. 3 outcomes possible, right? What would those possible outcomes be? Anybody? As a result of this healthcare module work that we did, what are the possible outcomes? What's that?
They could owe money back from
the subsidy. They have to pay back some subsidy. They get more subsidy. Or
there could be a penalty.
A penalty, even though now we're going to turn that off, but you still need to know where it is in case there is a value there. I want to make sure you know where that is, right? So those are the 3 outcomes that could come out of this. And sadly, unfortunately, they are all over the place. I wish they had a little section for healthcare, If I had designed it, it'd be different, but they didn't ask me. And those are, let me just see what I got here. Yeah. So if it's a repayment of subsidy, that is the outcome. And we'll call this healthcare outcomes. If it's repayment of subsidy, that is what's occurring, then that's going to flow through Schedule 2, line 46. And it's called, conveniently, repayment of subsidy. Yay! So at least that one, it's a little bit longer title, but that's that. If it's if they're due additional subsidy, it's called net premium tax credit. This one's due additional subsidy. And that one is this guy, okay? That's what it's called. And that one shows up on Schedule 5, line 70. And if they were to have a penalty for no insurance, then that one is on Schedule 4, line 61, and it's called shared responsibility payment. Isn't this crazy? I mean, look at all this. This one, number 3, is the one that's going to go away in 19, because that penalty should go away, and all we'll be doing is potentially having to repayment a subsidy or do an additional subsidy. But that is all this to explain what net premium tax credit was. Plus, is it any questions, thoughts? Okay. So that is how healthcare, the discussion on healthcare, which is very critical, very important, can impact our tax return and the numbers that we'll be addressing with our clients. Okay, wrap up our discussion on tax law. If I could have your undivided attention just for a little bit longer. I know you're anxious to get in and work on the exam and the cases, and I'm going to leave you plenty of time to do that while I'm here. But let me have your eyes and your ears for another 30, 45 minutes, and then we'll be out of here. Not out of here, but on to the next. Okay, so we are... If y'all will recall, we've covered all our credits. Anybody have any questions? We covered Affordable Care Act as well, the marketplace. Okay, come on now, chatter, chatter, no mas. Hello.
Miss McCoy?
Yeah. Do you need to go to the principal's office? Only if he can help you with a tax return. Anyway, any questions on health care, Affordable Care Act, or any of the credits? All right. Okay, so the last topic I want to cover with y'all, and then we're going to do the big wrap up on the 1040, is our other taxes. And as we look at our Form 1040, as you will recall, I think I can make this bigger, that'll help. Yeah, look at there. As you will recall, we are now down to line 13. So remember, today we started at a adjusted gross income, and then we took out either standard deduction or itemized deduction. Remember that? And what is the standard deduction for head of household? Anybody?
18.
Look, you don't even have to guess. It's right there. 18, right? Yeah. It can be more. And what circumstances would increase the 18?
Age over 65 years old?
Yeah. And whether or not they're blind. Yeah. Right? Okay, so again, you don't have to look far. There's your standard deductions. And of course, we understand that itemized deductions gives us the opportunity to beat the standard deduction, right? If we were going to do that. Yes, ma'am.
I have a question.
Sure.
I mean, does that mean that even with the ones who are married joint, they can increase that as well if they're both blind and older?
Yeah.
So that's,
it could go up 4 steps. Remember we saw on that table, it can go from 24. What's the maximum on married filing jointly? Anybody look in your table?
It's like 29,200.
Look in your table, tell me. Everybody look, can you please look in your 4012 and find the deduction tab and look and... $29,200. That would be that scenario where the taxpayer and spouse are both 65 or older and blind, right? And both are blind. That would increase it to the highest amount possible. Okay? So anyway, and then we would deduct, if applicable, the qualified business income deduction. Does anybody remember what that is? The qualified business income deduction. What's that?
Schedule C.
It's tied to the Schedule C, not net profit. Remember, it's the lesser of 20% of Schedule C nonprofit or 20% taxable income. Again, you don't need to know the equation, but just know it's tied to Schedule C, not profit. Okay? And so it's reducing that. And so that minus 8 minus 9 gives us taxable income, right? And then taxable income is what will trigger the tax amount. So for the first time we see tax liability. How much tax they, I point there because typically that's where that number generates. TaxSlayer did all that for us. And it says, okay, you owe that amount of tax. And then it says, add any amount from Schedule 2 and check here. And what was on Schedule 2? Schedule 2 had really only one other tax that could impact us. And it's this excess, repayment of subsidies. Schedule 2, line 46. So if they had to repay part of that subsidy that they were getting when they bought their health insurance through the affordable marketplace from Obamacare, if it were applicable, that's where it would show up. And it would add to their tax liability, right? Because it's a repayment. They got too much subsidy, so now too much tax credit subsidy, so now they have to pay that back. And that's what would show up included in that line, any amount from Schedule 2 and check here. And so then, so that could increase the tax amount. So the tax comes across plus anything on Schedule 2, and then there's your gross tax liability. And now we're going to start applying credits, if applicable. And the first one they could possibly get is the child tax credit and credit for other dependents. Remember we talked about that? What's the maximum amount of the child tax credit?
1,400.
Well, it's actually 2,000. It's 2,000, but the refundable portion is 1,400, right? Okay, and then what's the maximum age where you can get child tax credit?
17.
Under 17. 16 is the other way to say it, right? Right? And you have to have a Social Security card, right? Credit for other dependent, what's the maximum? 500. And who gets that?
People that are over
17
age.
years and
Yeah, any other dependent other than the child.
Yeah.
That's the other way to think about it, right? Any other dependent except for the child that was under 17 and had a social. Any other dependent is ostensibly eligible to get 500. It may or may not help somebody because it's non-refundable. So again, back to this. If you get to this point right here and taxable income is 0, right? Yeah. And there was, or line 11, even line 11, you can go on to line 11. If it's 0 here, then I don't care what they have in terms of non-refundable credits, doesn't help them.
It's just the credits.
It's just the refundables that could then put money in the, because they have no tax liability. So non-refundable credits can only reduce the tax liability to 0. Otherwise, you just walk away from it. Okay?
If we were to get somebody down to the tax liability of 0, like somebody that's on W-2 only,
Yeah.
that means that whatever their withholding was, they get all of that back.
That's correct. Yeah, that's right. But typically, they get to 0 with some credits, and then you get their refundable back. I mean, their federal income tax withheld. You're absolutely right. But so what ends up happening, especially as we're first getting started, we can go and put all this information in only to find out that, at least on the child dependent care, it didn't matter, but so be it. That's just how that works. But that can occur. Anyway, so then you take out the child tax credit, that's just the non-refundable portion is here. The refundable portion of the child tax credit, what we call the additional child tax credit, that actually comes through right here under Schedule 8812. And I'm sorry they call it a schedule, and I wish there were room enough to put in there additional child tax credit, because that's what that is. That's where the refundable portion of the additional child tax credit, if applicable, would come in right here. Refundable credits, there's your earned income credit, here's additional child tax credit, that's 8812, and this one, by the way, is the American Opportunity Credit, the refundable portion. 8863 is, but they just didn't have enough room to spell them out for us, so and it makes it even more challenging to find, but that's what's happening, okay? So, well, backing up again, you applied the non-refundable credits, if any, and now we're at this point on line 13, and now I'm going to talk to you just for a second about other taxes. What could increase the tax liability? And here we go. And what could increase the tax liability is shown to us on Schedule 4. The first line item is the old self-employment tax. Everybody remember that? What is the self-employment tax related to? What? What'd you say?
Schedule C.
Yeah, Schedule C, net profit. Remember, that's what drives our self-employment tax.
How about those, that amount, right? That other amount comes here.
The tax does. So I just put an example up here. If your net profit, this is Schedule C. Remember, this is my crude Schedule C. And if your net profit was $10,000, the self-employment tax is just shy of 15%. I just used 15%. I think it's 14.9 or 14.8. Anyway, 10,000 times 15% is $1,500, right? That is what's the self-employment tax, and that's what we would see right there.
The whole amount?
Huh? The 1,500.
Portion.
No, the 1,500. The self-employment tax. You see the whole amount right there. In my example, it's that $1,500. Okay? The next item is 1/2 of that amount is going to be applied as an adjustment. Remember our adjustments page, Schedule 1? Right here on line 20, where is it? Oh yeah, 27, line 27. See, it says deductible part of self-employment tax. That's the half of that self-employment tax. So $750 would be as an adjustment. Remember, that's way back earlier. We talked about that way earlier, but that's what flows back.
That's where I was getting confused. Yeah.
Yeah. And it's just because, remember, when you are, everybody effectively pays, this 15%. But what happens is that when you're a W-2, a wage earner, your employer pays half, you pay half. But when you're self-employed, you pay all of it, but then they give you an adjustment for half of it. So you're kind of you're getting fair treatment like the W-2 guy is. That's why they do that.
So like sole proprietors that pay taxes quarterly, essentially they could potentially get half of it back?
No, that's not what we're saying. All I'm saying is that whatever their self-employment tax calculates to, they get an adjustment for 50% of that.
So then why wouldn't they just make the tax 7.5 altogether?
Why wouldn't they make the tax on the...
Yeah, like just the actual regular tax.
No, because they want to collect 15%. They're collecting 15%, because who would you collect the other 7.5 from if you didn't get it from me? Self-employed. He's not going to give it to you. Right? Because they want to collect 15%. For a W-2, company contributes 7.5, I contribute 7.5. So,
but they're getting half of it back anyway.
Yeah, so to give you fair treatment. But they got to collect the 15%. They're just giving you benefit of that 7.5, that 50%. That's all we're saying. But does that make sense to you? Okay? So, other taxes we were talking about on Schedule 4. Okay, so that is what's driving the self-employment tax. And it can be often a big number because most of our clients are not paying an estimate of what what they think their taxes are going to be, and so they're caught, unfortunately, at the end of the year owing, you know, $1,500, whatever the amount might be, and then they have to do a payment plan and pay it off, et cetera, et cetera. But it is a separate. It's a separate tax because remember, that's a tax, right? That's self-employment tax. And remember in 1040, we had this tax calculation right here on 11A. That was a tax that was calculated based on taxable income. And that's a whole different calculation of numbers. I can't remember. Do you know what the tax rates, the range for individual tax?
No, I don't.
Yeah, I don't even know. Yeah. I think it goes from 10%, starts at 10% and can go as high as 25, 27. I'm not even sure anymore. But it depends on how much you make. Whereas the self-employment tax is always, you know, approximately 15%. It never changes. But the other one graduates, gets higher the more money you make. But most of the effective tax rates I see for our folks is like 10%.
And then the tax brackets have changed as well.
I know they have.
Yeah,
They expanded
so
those.
They made it look good, but
it's yeah.
It's really not.
Yeah. But so it's two different taxes that a Schedule C person could ostensibly have to pay. And the federal income tax, again, which is calculated, because remember their net profit comes through the same waterfall. Remember it came through Schedule C on 1. It came in right there, line 12. Comes in on line 12, Schedule C net profit, and then that goes back and is picked up right here in line 122, and then is included in all their other income. Okay, so let's finish talking about what other taxes there could be.
Where is that in the book?
What's that?
What we're going over?
Taxes?
What?
Well, let's look.
Other taxes are H, but I'm not seeing just what we're talking about.
You're not seeing self-employment tax? Well, let's look together and see, because this. Let's see if it's with the income section where Schedule C employment income is on D13, and there's a whole section on that. Where you can see I used that. I never even refer to that for it anymore. It says H1. This is the only reference I'm getting. But the discussion on it, all it says is entered automatically from Schedule SC. TaxSlayer calculates the amount using the entries. Unfortunately, that's all they say. Okay? The other type of taxes, let's see, we have additional tax on IRAs, other qualified retirement plans, and other tax favored accounts. So this is the scenario that we've talked about repeatedly, where if somebody takes money out of an IRA prior to the age of 59 and a half, then they could potentially be subject to an early distribution penalty of 10%, and that's where it would show up. And again, we can turn off that penalty if there is a qualified exemption for that, and we can see those in that same section. We should be able to find those, and they are on H4. If you look on H4, everybody with me on that? There's the exceptions that in the codes that could potentially turn off a 10% penalty, okay, for an early distribution. And like I was saying, that you can read them. They're long and lengthy. There's distributions due to total and permanent disability, distributions due to death, IRA distributions made to unemployed individuals for health insurance premiums. I'm skipping around. The ones I've used for our clients have been IRA distributions made qualified for higher education expenses, IRA distributions made for purchase of a first home up to $10,000. That's the two that I've seen most often. And like I said yesterday, I had a woman come in and she had taken she's only 30 years old, and she'd taken $4,300 out of her IRA, and that was going to result in a $430 tax right there. Because the penalty, she was 30, obviously under 59.5. And then I said, well, what'd you spend it on? She goes, oh, we just bought a house. We bought a house. And I said, oh, okay. Then I think I've got an exception, and we can put that into the system, and that went away. So she didn't have that tax. Question? And that will be on one of your scenarios where you're creating a tax return, and they took an early distribution, and you need to look and see if one of these exceptions apply, so you can input that. You would input it into Form 5329, and it tells you there on line 59 right here, it says, additional tax on IRAs, blah, 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 a tax form 5329. It's through this form that you turn off that tax. Okay, that's where you would input this exception and turn off the 10% penalty. Okay. So the next one, let's see, repayment of first-time home buyer credit from Form 5405. We see this. So what happened was in 2007, our economy was in the tank here in the States, and the government was giving various incentives to people to, one, buy cars. You used to be able to get, I can't remember how much you could get, like $6,000 towards a certain type of car. And they also, if you were buying a home for the first time, they would give you a loan of up to $7,500. The following year, they turned it into a grant. So, wah. The people that got it in 07 got a loan, interest-free, but they had to pay it back over a 15-year period. So that's $500 a minimum that they have to pay back. And we collect on that loan for the government through the tax return, specifically on this form. We would know whether this applies to them or not. How? Anybody? Last year's return, one, but what else?
Does the government send them something?
How about your intake? Check out the intake. Somebody find out where that question is asked. If you would, please.
Life events, part 5.
Part 5, life event. There's a question. What does it say?
Purchase.
Oh,
First,
number
receive
7.
first time.
Number 7?
Yeah.
You see the first time buyer's credit in 2008.
There you go. Yeah. So there's our clue right there. That obviously, like we said, last year's tax return, because it would have the same entry. So they often forget this one, and so anyway, if they do forget it, what does happen in terms of the IRS, the government notice, it'll get rejected, and we'll get word back that they forgot to include it, and then we call them in and we work through it, and it reduces their otherwise refund or amount owed. I'm sorry, reduces the refund or increases their amount owed, depending on what else is happening.
What is 68?
What is what?
68, household employment taxes?
Yeah, it would, we don't ever see that. I'm not going to cover it. I try to stick to what we actually have to, what you're going to deal with. But what it is, to answer your question, if you have live-in help, then you're paying that 7.5%, you know, for them, like a nanny or something. It could be a nanny or something like that, and that's where it would come through. unreported Social Security Medicare tax, by the way, that's covering tips. So if typically tips can be reported on the W-2. But some of our clients are hostesses, waiters, waitresses, what have you, may tell us, hey, I had cash tips as well. And so we need to take that Social Security tax and all that other out of there. And by throwing it into the tax return, it will generate through Form 4137 how much tax they owe. It's just kind of like a self-employment tax, but it's their half on tips that wasn't otherwise collected by the government. So they're looking to get that.
And where does that go?
It comes through, it'll come through on 58.
Okay.
Unreported Social Security and Medicare tax. And from 4137 is the tip income that needs to have that same impact. Yeah, monthly tips less than $20 per month, not subject to Social Security or Medicare taxes, but greater than $20 per month from one job must report tips to the employer, and the employer withholds the SS and the Medicare. So this is for the cash tips. Okay, what else? We have healthcare, line 61 is healthcare individual responsibility. Does anybody remember what that is? It's also known as shared responsibility payment.
For not having the coverage.
Yeah, for not having health insurance coverage. That's where the penalty would show up. And again, if you see a value here, let's go talk about it, because there should be no penalties, because we can use general hardship now, right? That's why I want you to know where it is, to make sure when you're reviewing your tax return for your client that something didn't pop up there, because if so, then we got to go find out why. Okay, that's that. And I think that's going to cover the rest of the other taxes. So all of these lines get added up, similar to the other schedules, and it subtotals to row 64, which says add the amounts in the far right column. These are your total other taxes. Enter here and Form 1040 line 14. So if we go back to the 1040, Schedule 4 results flow through right here, right? As other taxes. And then you've got total tax, which is 13 plus 14. Okay, so if they have a liability at that point, regardless, now what the taxpayer is going to go do is it's going to pull in the income tax withheld. And all that's going to show up on row 16. So it's going to go to all your inputs. That's why it's so important you get these inputs done correctly. And it's going to aggregate all of the income tax withheld. So like on Donnelly, right? There was income tax withheld on the 1099-R. There was on one of them. There was income tax withheld on the W-2. And there was also income tax withheld on the Social Security, as I recall, right? So those three numbers combined, whoop, will show up right there. That's, in my mind, I explain that as like a prepayment. That's basically what it is, right? So that's to their credit. And then here come the refundable credits. Now we talked about that, earned income credit. We now know 8812 is code for additional child tax credit, right? And 8863 is code for the refundable portion of the American Opportunity Credit. And then it says, add any amount from Schedule 5. Well, what is on Schedule 5? That might come over. So, Schedule 5 has a couple of items that, again, are like prepayment. These are like prepayments, if you would, including the first one you see is estimated tax payments and amount applied from 2017 return. So remember we said the self-employed guy is supposed to be, or gal is supposed to be making quarterly payments. That's where we would enter that amount. But they would have had to tell us that they were making these estimated tax payments. And it's on the intake sheet. It's one of the questions we asked. Did you make any estimated tax payments? So they give us that information, but that's another form of prepayment to the IRS.
What line was it, sorry?
What's that, 66 is what I'm talking about? Yeah, I wrote 66. So one of the options you have with your refund is you can say to the IRS, hang on to it and let's use it next year. Okay, and that's what this is referring to, an amount applied from 2017 return. Again, they would have to tell us that. We wouldn't know that unless they had told us that. Or we can look at, if we had last year's return, we could look there and see that it occurred. I don't think I've ever seen where somebody has, I sure wouldn't tell the government to hold my money till next year. You have to believe they're going to be around next year. No.
What if they shut down?
Yeah. What's that? Oh,
What if they shut down?
yeah, right. What if they shut down? Right? No. Anyway, but estimated tax payments are very real, and sometimes we'll see that. And then also other prepayments or refundable credits is the net premium tax credit, and we've already talked about that one. That's where you are due additional subsidy, right? Bought your health insurance through the marketplace, you got that monthly help, monthly subsidy, and because you made less than you told them you were going to make, you got more credit.
What happens if you don't request, if you don't go through Obamacare health insurance, you don't get that subsidy?
No subsidy unless you go. That's right.
Unless you go there?
Unless you, for marketplace, that'd be the only place that you would get the kind of subsidy we're talking about.
If you don't, then it doesn't happen, nothing matters.
No. No, none of this applies to you.
Applies.
Yeah. And what else did they have coming? I think that's the only ones that we would see. Yeah. Those would be the two other potential refundable credits, because we've talked about all our refundable credit. And these other line items just don't apply, so that's why I'm not going to get into them. You've got enough in your heads already to digest. So that's all your refundable credits, and then that's adds, then it says add any amount from Schedule 5, which we just talked about, and that is your total pluses, if you would, right? And then it gets down to, do you get a refund or do you owe? Down here. And calculation, it'll all be calculated for us. If they get it says this is the amount that you overpaid. In other words, you get money coming back to you, right? Whatever that amount is. And then their choices are they can put it into two accounts, up to two accounts, either checking or savings or split, whatever. And we'll need their routing number, which is the bank ID number, and then the account number. And again, they'll provide that to us. It could be on last year's return if they used direct deposit, and they would have told us in the intake whether they want direct deposit or not. And we can, assuming it's still good, and we can input it, we can use last year's tax return at the bottom of page 2, and you'll see the information there. That doesn't carry forward. A lot of stuff carry forwards, but that doesn't, because we want to make sure that they didn't change bank account or bank or whatever it might be. We also, as part of our mission, we encourage our taxpayers to save money. And so there's several options they can do and we can help them with. One is obviously put some in their savings account. 2, we offer for sale, and you'll learn more about this on site, we offer for sale savings bonds in increments of a minimum of 100, and they can allocate part of their refund to buy some savings bonds. And then we have a scratch-off card we give them for doing so to incentivize them. And then we also have a partnership with the Credit Federal Union, and that they open an account there, and again, you'll learn more about this on site. They can, depending on how much they have in that account at the end of the year, they can earn up to a bonus of $200. So if you have at least $500, $501 in that account at the end of the year when we take our snapshot, then we've raised the money to pay you $200 bonus. So the bonus is 50, 100, or 200, depending on what. But again, you'll see more of that. But it's really attractive for people. That's 40% return, and heck, you can put it in on December 15th and pull it out on January 1st and get your money, you know. But hopefully that's not the case. We want people to save for the rainy day. So anyway, it's a cool program. That's a big part of our mission too, is to help people start thinking about saving some money if possible. So that's the scenarios if you have a refund coming. And if you owe, the big horn goes off. Everybody has a sad face. But no. But they can either choose to pay, schedule a payment date. We can do that in the software. And we give the software the routing number, the account number, and a date on which they want the money pulled out of their account by the U.S. Treasury. And they can do that as late as April 15th, because that's when it's due. Or they can enter into a payment plan with the IRS, depending on the amount. And all of that is between, although we can set up a qualified payment plan, they will have a communication directly with the IRS. We e-file it regardless, we'll e-file the return, but then the payment plan is something that they'll take up directly with the IRS upon receipt of a letter from the IRS. Who will send them a letter and say, okay, we got your return, but where's the money? And then they talk about it. Okay? So that is, in toto, the tax return. Any questions, thoughts? Okay, then that concludes the, that doesn't conclude. I want to say a few other things. Number one, when you get to this point, let me go to my tax return real quick. I want to show you something. So let's say I've just completed Donnelly, right? Y'all follow me on the screen. And as I'm sure you've already figured out, this left column is great for navigating, right? And so summary print gives you the 1040 plus schedules 1 through 6. And if you click on these numbers here, page 1 is the 1040. Okay, that's all of that. And page 2 is schedules 1, 2, and 3. This is the quick glance. 1, 2, and 3, right? And if you click on the 3, you get schedules 4, 5, and 6. This is just showing you navigation and the tricks of how the software works. So that way you can check your own work and start looking, asking yourself questions, etc. But and also check it out. If you have a problem with a number and it's in blue like this, if you click on this number, it will take you to the input directly. That's pretty cool, right? That way you can go check your work or whatever. Did you see what I did? You go back to, where was I here?
How does it know if there's a problem with the number?
You would have to know.
Oh, okay.
Now I'm just saying, if you have a question, you can go back. Yeah.
One more time.
Yeah, so all I'm saying is that if you're in summary print and you're like, I need to go check this input on this line, right? So I come over, hover over it, see how it's active, click on it, and it takes you back to closer to the input side. Okay, so don't forget you need to do this health insurance module. So like in Donnelly's, you open it up and it'll take you through all the questions. Yes. Did they have health insurance? Let's walk through it. Yes. Did you purchase health care from, this is Obamacare, this is that question, healthcare.gov or state marketplace, and they did not, right, in this case, so we said no. If they had, watch this, if we'd said yes, what would happen? Then it would, yeah, then you have to verify your household members, and then it says, were you insured for all 12 months? And you say yes or no, and in our case it was no, because Ryan and Mary only had it for 10 months, right? And then you have to check off the months. And Mary only had it through October, And Ryan had it through October. And okay, here we go. Because I said they bought health insurance through Obamacare, then it comes up, did you receive a 1095A statement? Remember that 1095A I said they had to have? So we hit yes in this case, and then you have to answer these questions. Are you required to repay? And we say no to that. Is your household below 100% of the poverty line? No. Do all forms include coverage for January through December with no changes? If you said yes to that, then you would just put in the annual amounts. But if we say no, then you actually have to put in each month by month by month, entry from month to month to month. And that's all taken from the 1095A. I just wanted to show you, just kind of, I know it's quick, but just kind of so you can get a heads up on how that works. Okay? And now I've totally messed up the health insurance thing. See if I'll go back, because I need to keep my answer the same. So anyway, that was part of it. Let me just change that back, and then we have to continue. So we say no this time. Oh, so we'll work through the exemption. Let me show you the exemption. Okay, so we said 12, 10, and 10, right? Mm-hmm. And we did the months they were insured. Months they were insured. Now it says, now at this point, it's looking for the total household income. And what it's asking for on this worksheet is if, remember the tax return has the income for the taxpayer and spouse, right? That's all it could possibly have. But in terms of figuring out the penalty on not having health insurance, remember I said it's the greater of 2.5% of household income, or those set amounts? Well, household income could include dependents you're claiming. And the only way you're going to get their income into tax layer is by adding it here. But you would only include them if they had a filing requirement. Okay? And that's where you would put that money. It doesn't apply in this case because the kid didn't work. And then it says, okay, did you qualify for an exemption due to circumstances or receive an exemption certificate from the marketplace? Well, we know he didn't get a certificate because we would have had that. Remember the alphanumeric number I said? But is there an exemption for not having health insurance for 2 months?
Yes.
There is, right? So we say yes. And I actually had already input him as B. Let me see if I can. Yeah, so this is what it looks like. So first you pick Ryan and say, Ryan, do you have a marketplace insurance certificate or going to apply? No. And then you have a drop down. And that's where these different options are. There's short gap in coverage. That's the maximum of 2 months, right? Here's the I-10 people, citizens living abroad, and certain non-citizens. So if they have an I-10, they get that exemption. And then here's general hardship, which is our default. Nothing else, give them that one. Okay? Follow? Sorta? You'll see it. And then you have to say this exemption applies to the months that they didn't have it to turn off a potential penalty. Okay? And then you do it again for whoever else. In this case, we had to do Mary, and I've already got her in as it's the same thing. You'll see. I picked Mary this time. Mary, and then blah, 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 short gap, the 2 months, and off we go. All right, so once you get all of this done, then you go into e-file. Let's see if this software has what you're going to see out in the field. That doesn't apply to us. Yeah, and then, so it's here. Then we continue. Now we've prepared the tax return and we're just doing the cleanup. And you'll see, please select federal return type. You can do e-file with the paper check. Some people don't have a bank account or they don't want it to go into a checking account. They want it to come to their home. And we can do that. We'll still e-file it, but their refund would come in terms of a paper check and be mailed to their home. And that's that option.
Even if the address is different than the W-2?
Even if, yeah, because what dictates the address for their check is what's on the tax return.
which is what's pulled from the W-2, right?
No, it's what we input. We input that.
You're gonna input two places, what their physical address is now on the first part, and then what's on the W-2 matches.
That's right, but that's just to match the W-2. It has no bearing on.
It doesn't go to the return.
That's right. Yeah, good way to say that. Thank you. They can also do a paper return with direct deposit, or a paper return with a paper check, basically is what that means. But those are the different options that we have available to us, okay? And we'll know that by talking to them. So we pick one of those, we'll say direct, no, then, but if you hit direct deposit, then we go into taxpayer bank account, and you see here, this is where you put the routing number. If it's a checking account, we'll say it's Bank of America, Barn of America, no, Bank of America. Yeah, and then really cool, you can hit this button and that'll pull the refund amount. And then it's 111. I know this by heart. It's really sad after you do a lot of these returns. You know these things. And then you do 1, 2, 5, 6, 7, 8, 9. We'll try that, see if it takes it. And then you have to repeat it because it wants to make sure you didn't mess up. 2, 3, 4, 0s, 2, 5. And you go 1, 2, 3, 4, 5, 6, 7, 8, 9. And see, this is where you can split it. There's a second bank, actually three bank accounts. My begging your pardon, that you could split the refund into. And here's where you purchase savings bonds if they wanted to purchase savings bonds, et cetera, et cetera. And then we hit this consent. Oh yeah, I didn't say the other. Yeah, this tells by them agreeing to this consent. They agree that if they come back to our VITA location or other VITA location, we can pull the information from 1 year to the next. That's all we're saying. And then we enter primary PIN. We just do 1, 2, 3, 4, 5 for the first taxpayer, and today's date, and 6, 7, 8, 9 for the second one. Don't worry, we'll go over all this with you out in the field. And this isn't on your this isn't on your test or anything. I was just going to give you all the benefit of seeing what happens after you do your work. We hit save, and now you call, and this is the point to all this exercise. Now you call your reviewer. And your reviewer will come in and review your work. And I go to, you can see it here, I'll go do all this myself, quality review, I hit print return, and now I have a screenshot of everything I need to look at to review your work. See if it downloads. Yeah. So I can check birthdays and socials and spelling of names, and then it's going to give me the W-2s that you input the information, and now I can check against the final document and make sure you did it all correct. So I check that. In this case, there's the 1099-Rs that you input, and I'm checking all of this, make sure you hit all the codes, boxes, and ultimately, that's the form they have to sign to give us permission to send their tax return electronically. And then we have their tax return, and I look at all that, I look at all the schedules, and I can see everything set.
So do you print these out?
We do, ultimately.
Okay.
Yeah. So from this, actually, close that, and then when I'm ready to print, I go to a print package that I have for my site, and that's what we give to the customer. Because if they e-filed, we're sending them home with a copy of their tax return so they keep for their records, right? And they need to check it. They check our work. We walk them through the tax return to make sure they agree with the numbers and understand the numbers.
So, I mean, is that all in one
sitting? Absolutely.
So they don't have to go anywhere else. It's just...
It's done. Assuming we have all the information and we're not putting it on hold for some reason, then they sign the paperwork, we transmit it, we'll call them if there's an issue. Otherwise, they're good to go and they just wait for their refund. Or they pay what they owe. Okay? So quality review. Two things I remind you. Do not disclose amount of refund or amount owed until your return has been reviewed. Because as I said, I think I told you all last time, the worst thing that can happen to you is that you quote them a number and it changes. And now they've lost all confidence. They get nervous and they've lost their confidence in you. And there's no reason for you to take that step, that risk. You don't need to. Let us review it. and if there is an error, we find something that we need to change, I'm going to let you change it, so we learn, from our mistakes or oversights or opportunities missed, whatever that might be. We do that together, and then we discuss it with them. But we're going to walk, because I'm telling you, as I said, the first thing they want to know when they sit down is, how much is my refund? I had a guy last night, he goes, how do I adjust my W-2 so I don't pay so much federal income tax withheld? I said, I don't even know if you owe or not. How can I even tell you? Sure enough, he owed. He was surprised. I said, I don't think you need to adjust your W-2s, Yeah, you need to adjust them up. Yeah, fortunately, it wasn't a big amount. And don't forget that we can do amended and prior year returns. And if you see something on a prior year return, or there is no prior year return, as you're talking to the taxpayer, we can accommodate them on that. And basically, if you're due a refund, you can go back 3 years. So basically to 2015. You can't go beyond 2015 if you're due a refund, because the IRS says, too bad, you're lost. You should have come back to us sooner than that. And if you owe, that goes back forever, and they would have sent you letters that said you owed. Or if you want to file taxes and you hadn't, then you can do that at any time, so that you can get your credits. Okay, so yeah, that is, and amended returns will sometimes happen too, because they'll come to us, like in 18, and they'll say, oh, guess what, after I filed my return last year, I got this 1099. And you're like, oh, and I forgot to include it in my 2017. We're like, no problem, we'll do an amendment and get that included for you. Okay? Any questions, thoughts, comments? Yes, ma'am.
If they have one of those identity pins,
yeah,
where do you enter that on the return?
Good question. Okay, so we're talking about a scenario where there could have been identity theft, and sadly it happens a lot. And if so, then a taxpayer would have to go to the IRS and get them to give them a 5-digit identity PIN number that then has to be input into the tax return. I think they have to do that for like 3 years or 5 years. I can't remember going forward. And it's a new one every year. Yeah. And so, anyway, to answer your question, that goes in federal section. If I remember correctly, it's miscellaneous forms. Yeah, there it is, right there. IRS identification PIN. And that's where you would put it in. And it's specific to either the tax, in this case, any one of these individuals in our scenario could, if that were a situation that they had had their identity robbed, then they may have that PIN. But it comes in a letter from the IRS, and we would see it's clearly marked for us. And they should have told us that in the intake. There's a question regarding, have you been a victim of identity theft? And if so, any correspondence from the IRS, and we would input that there. Yeah, because otherwise their return won't be, it would be rejected for lack of that. We would find out. Okay, good question. Anything else? Okay, well, I can see you're all chomping at the bit to get back to your exercises. I'm here till 4 to help you. Let's open up. That concludes the tax law section.